Good morning, everyone. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get to the top 3 things that you need to know to start your morning. First thing you need to know, Tesla's first quarter earnings made it clear price wars have consequences. The EV maker, they saw the automotive gross profit margins tank after repeatedly slashing prices across its vehicle lineup. Net income dropped on the decreased margins despite a 36% year-over-year growth in deliveries. CEO Elon Musk justified the narrowing margins, saying the company is comfortable prioritizing higher volumes over profit. He's also indicated the company is comfortable shrinking margins further with 2 rounds of price cuts already this month. Second thing that you need to know, the debate over the U.S. debt ceiling is boiling over in D.C. House Speaker McCarthy presented a plan to raise the debt ceiling by $1.5 trillion tied to sharp spending cuts that left Democrats irate. One Democratic lawmaker slamming the proposal as a Trojan horse to cut Americans' social safety net. On the chopping block, Biden's proposed student debt relief plan and billions of dollars in clean energy tax breaks. But lawmakers are running out of time to come to an agreement. If an increase doesn't pass, the U.S. could default as early as June, an event Treasury Secretary Janet Yellen has warned would cause economic and financial collapse. And the third thing that you need to know this morning, a stronger than expected first quarter for IBM. The tech giant reported solid gains thanks to expanding margins with strong performance in software and consulting. The company also furthered its investment in AI, partnering with Citi to implement tech for auditing and compliance. Looking ahead, the company offered a slightly conservative forecast, anticipating a slowing in consulting revenue as customers cut back on costs.
Well, Tesla's EV markdowns took a big toll on its profitability in the first quarter. The EV maker's gross profit margin dipped below 20% to its lowest reported since the end of 2020. So what do we learn from Tesla's latest earnings report? Let's break it down with Yahoo Finance's Prasad Subramanian. Basically, we learned that it costs you margins if you keep cutting the prices of your cars.
Yeah, I think there's this, the bull and bear story now is the bears are saying, look at this, they destroyed their leading margins, they're cutting prices because their demand is slowing. This is what's happening. Yes, they're growing volumes, but it's coming at the expense of profits. On the flip side, you can say Tesla is saying that we're going to become more of a mature company here. We are going to actually use our advantage, our pricing and cost advantage to flood the market with our cars, gain market share. We'll take the hit on profitability, but in the long run, we can make it work because we can sell connected services, we can grow our energy business and all that other stuff. So I think that's the debate right now, but right now the bears are winning clearly today. And I think there's going to be a reckoning with what the company is going to be kind of viewed as going forward.
Yeah, and it seemed like the tone that they were striking on the call was that this was intentional. It was somewhat self-inflicted in order to really make sure that they're having this wave of demand generation that they're able to then cash in later on, keeping customers within that broader kind of ecosystem of Tesla products, if you will, if that sounds kind of on par with what you heard on the call.
Yeah, for sure. And I think that the earnings call was quite not somber, but just very kind of sober in some sense, right? Very no fireworks, no dramatics. This is the story here. But I think there's I think some of Wall Street or investors are not really buying the story. They're saying, hey, we think you have a serious demand problem, and that's why you're cutting twice this month. I mean, that's not going to be reflected in this earnings, but it's just something to keep an eye on. And they hinted that there's more to come. So I feel like buyers, are you going to wait to buy? Why not, right?
And the other thing is, even though Tesla can control what it can do on pricing, it has less control over what happens with costs, and its costs are going up. Now, on the call, they talked about over the longer term cost moderating, particularly for things like lithium. But there is, as always, a credibility question, I think, when it comes to Tesla. Elon Musk has said things in the past that haven't come to pass, or at least on the timeline. Witness the Cybertruck, which is supposed to finally come out this year,
it's right? It's going to be a Hall of Fame product, according to Elon Musk.
Sure it will. But, I think that credibility kind of, in some ways, also gets to the core of investor questions about this company.
Yeah. The overly kind of bullish kind of tone of we can do this, we can do that. Cybertruck's going to be here at the end of Q3. That's what they're planning to do, right? We'll see. Can they hit that deadline? But back to the kind of the commodity stuff, Brad, I mean, how many times are they talking about the storms of the economy, right? The economic storms, some of the weather forecasting, kind of sort of hedging his sort of, this is my call, but this all depends on on external factors being okay, no economic kind of booms or busts. So he was couching it in those terms, but he said long run, yes, lithium, we're going to build a refinery down in Texas. That's going to bring our prices down a lot. But you can't predict these things. But I think you're right. The big picture, he's always talking about. You know what he said today, or said yesterday? He said that he expects, and he said it with a laugh, that full self-driving will be fully autonomous by the end of this year. He said it with a laugh. Even he knew. Yeah. That it was a very, very long stretch.
Well, according to them, full self-driving beta has hit about 150 million miles as of this point in time in beta. You mentioned Cybertruck and him talking about that being a Hall of Fame product. Well, right now it's a backyard all-star for Tesla, just in testing phases at this point. And then they also talked about stationary storage growth significantly exceeding vehicle growth in the future. That was one of the bright spots in the report in terms of growth, but still makes up just a small portion of their overall revenue base. Yahoo Finance's own Pras Subramanian. Thanks so much, Pras. As investors digest Tesla's latest earnings report, Wall Street remains at odds over how you should play the stock in your portfolio. Let's bring in Tom Narayan, who is RBC analyst, who's bullish on Tesla stock with an outperform rating. We've also got Roth Capital Partners senior research analyst Craig Irwin, who has a neutral rating and an $85 price target. Craig, I want to begin with you. What did you make of the tone, the tenor that was set from Tesla during last night's call?
You know, it really wasn't a big surprise for us. We've been consistent for a long time saying that 100 new EVs on the market in 2023, EV models from competing producers, there's going to be significant pressure. So there was a correction the back end of last year when they hit a demand air pocket and when obviously the consumer got a little bit weak for them. Wall Street got a little too bullish. And, it's a growth stock, so they know they have to keep that growth rate up. 36% deliveries growth is not all that impressive when they're guiding for 50. Really it was only 18 on the top line. Net income declined by 23%. I'm looking at this and I'm saying, the 230 basis point miss on margins, is not a huge surprise. And things are going to get worse. It's a great company, great products. Love the fact that they pioneered this market. But there's a lot of other companies that are going to be successful here too. And the valuation is egregious. Just the move today, 9% more or less, is about the entire size of Ford's market cap, to put it in perspective. So egregiously overvalued, not unexpected, quite bearish for the equity. But I think the sector is going to do very well for the long run.
Tom, let's get you in here because you did lower your price target, but you're still at 212. You're still at an outperform for the stock. So clearly you don't think it is egregiously overvalued here. Do you, though, see deteriorating demand for Tesla vehicles?
I think that's ultimately what everybody wants to know, right? It's easy to get kind of caught up in a specific earnings quarter and kind of lose sight of the bigger picture. And I think what happens here is there underlying demand problems at Tesla? I don't think this is enough evidence to suggest that. And the reason is, look at the overall auto industry. This is the biggest fear right now happening, is that pricing has to come down. From 2016 to 2019, pricing was up 9%. From 2019 to 2022 was up 37%, right? So I think Tesla is just being the first one out the gates to cut pricing. Remember, pricing went up a lot in 2022. Others are going to follow. The other thing is they're targeting the ICE market, not just EVs. They made that very clear on the earnings call yesterday. And it's a volume story and a growth story, as you pointed out, right? Name any other automaker going from 1.2 million to 1.8 million units this year. Huge growth. You have new products, Cybertruck, the potential for the Model 2. Ultimately, it's not really, I don't think it's really a Tesla demand issue. It's just an auto demand issue with affordability potentially being an issue. I don't know when anybody else making EVs as profitable as they are. You pointed out Ford, what did they just announce what their EV margins are? They're very much dilutive. So Tesla has the ability to cut pricing. And I actually think that other automakers are inevitably going to have to follow suit.
Tom, I want to stay with you for a second. What pricing do you believe that the Cybertruck is going to need to come in at in order to hit some of your own targets that you have for the stock, for the company as well?
Yeah, I think it's going to come out at pretty strong pricing. there are rumors that it could actually come out being actually not that high. I think it has the ability to come out in the 50, 60,000, maybe even higher range, but it may actually come out at that 50 level, maybe even below. It's unclear, but ultimately, this is a segment that they're completely not in. And in the US, it's a ginormous market opportunity for them. We've heard reports of what orders are potentially for a Cybertruck. And we understand that how they're making this is completely different than how they make any other vehicle that they have. So it has a cost advantage as well. So it's unclear on cost, but I think it could come in actually below what a lot of folks think. And I don't think it needs to be all that high. Again, you pointed out early on, this is really a play for them to get the fleet as big as possible so they can sell other products, FSD, Autopilot, et cetera. So at the end of the day, the subscription revenues you collect from that come at massive margins because it's R&D that you can scale out. And then you can offset price cuts really easily. So that whole autonomy point with greater volumes, I do think that's been missed on the market. And Elon said it a couple of times that it's probably the most profound thing he said on that call. And I do think that there's a very good chance that in the future, maybe not tomorrow, this will wind up being the biggest takeaway from this call, their ability to monetize on autonomy.
I want to dig more into autonomy in a bit, but first I want to linger on the Cybertruck for a moment, Craig, and get your take, because I look at that thing, which is now years late. It looks like something out of Mad Max. I don't know what is the real market for this thing when it actually hits the market, if it hits the market? Is it going to be a bust or is it going to be this huge thing?
Let's get real, right? Let's get real. The only way they're going to have a sub $50,000 Cybertruck is a two-wheel drive truck. How many trucks sold in America are two-wheel drives? It's just not going to happen. The pricing of this thing is probably going to end up being, $70,000, $80,000, $90,000 for the four-wheel drive version. I have a very hard time seeing that being a compelling product in the market. The reservations numbers they've shared with us are based on a $100 deposit, which is almost like a joke. It's not based on thousands of dollars in deposits where you've really got skin in the game. I'm skeptical. I'm not a big believer in the Cybertruck. I love their willingness to step out and do something innovative. But if that's what people want to hang their hat on, so be it. I just, I don't think you're going to sell a lot of two-wheel drive trucks in America.
Craig, I'm reluctant to call shapes innovative. It's a pentagon on wheels. Let's be real.
With unbreakable glass, right? So
depending upon what you throw.
Honestly, I'm skeptical. I'm skeptical about the Cybertruck. This mini car it was supposed to be launched in 19. The reason they didn't launch it in 19 is the margins would have been massively dilutive. That's why we saw this dog and pony show at the most recent analyst day where they're talking about modular manufacturing. That's not unique. All OEMs have looked at that. Many of them have adopted it for sub-components already. It's not unique to Tesla. It's not unique to Tesla. The mini car is going to be margin dilutive. That is going to be much more serious than the price issues that they're working through right now. I think we have a troublesome period for the equity for the next few years. And, realistically, EVs are inevitable. There's going to be a lot of companies that are successful. There's going to be a lot of companies in the supply chain, either on the battery side or the component side, that are going to be successful. I just don't think Tesla's the one to invest in here. I think there are other great names. And that we need to acknowledge Tesla as a pioneer that got this market started, and the impeccable execution on great products. But the equity, I think, is troubled.
Hey, Tom, I also want to just pivot back to something that is going to be amazingly important for them is the free cash flow. And they took a free cash flow hit in this most recent quarter. Is this company going to run into a free cash flow problem in order just to ramp up to the type of customer base that they want to build out to?
Yeah, I mean, this is something we're noticing across the auto industry for Q1, right? So it's likely a working capital issue. A lot of companies are reporting negative free cash flow for Q1. Again, it's very difficult to just extrapolate so much after one quarter. This is a company that is profitable in selling an EV product where the entire industry is migrating towards a ton of growth. again, its pricing is coming down to where ICE level pricing is. And they're still profitable. So I don't really see why there's a cash burn issue. There are pure play EV players out there that have real cash issues that are generating negative cash for protracted several years. This is not one of them. Plus, they have this a pretty significant market capitalization, ability to finance growth if they need to through other means. I just think like folks are getting a little too caught up maybe in one earnings print. We need to really see what happens. I know next quarter it's probably going to be challenged as well from a margin perspective, but he said it flat out on the earnings call that once we see evidence of macroeconomic slowdown, reversing, they'll raise pricing again. And we saw that last year. There were prices going up, there were prices going down. So there could be quick adjustments to pricing when needed.
Yeah, although free cash flow has been a perennial issue, to be fair, for Tesla. It's not just a one-quarter issue. It's come up through the years occasionally. I do want to circle back, though, to autonomy real quick, Tom, and dig into that just a little bit, because this, to me, falls in the category of promises from Elon Musk. Yes, full self-driving exists, but it's not full self-driving, right? So I just wonder, it's one of these things that in theory, sure, is a huge opportunity. I just wonder where the theory meets the reality.
Yeah, I mean, I think there's a lot of these words and, that get kind of lost in the reality. Yeah, you're right. It's probably not the best marketing, right, approach to call something maybe what it's not. But at the end of the day, people are willing to pay for a product.
He should bring back his marketing team, Tom.
Right. If you want to call it L2 plus, right, or whatever, maybe that's not full self-driving. It's still an amazing product. I don't know if you've ever tested out a Tesla with its L2 plus features. It's pretty amazing what this can do, right? And folks are willing to pay more. Now, the attach rate has come down, right, since initially it came out. But what happens now, remember, they're getting that $7,500 credit. A lot of other car makers in the U.S. are not. What happens if Uncle Sam is paying for that and this consumer gets Tesla now for a lot less? Maybe they spend that extra cash on some of these services that can't come at huge margins, totally can offset these price cutting. And by the way, this price cutting is going to happen throughout the whole industry. Tesla's just more rational and starting it first. They're better able to capitalize on the subscription revenues. And I think others probably aren't as much.
Gentlemen, thank you so much for playing today. Appreciate it. Just as a reminder, Tom Narayan, RBC analyst, has an outperform rating on Tesla. 212 is his price target. Craig Irwin, Roth Capital Research senior research analyst, has a neutral, and 180.59 is his price target. Thanks, guys. Appreciate it. Well, House Speaker Kevin McCarthy debuted his plan to lift the U.S. debt ceiling by $1.5 trillion, kicking off the next phase of the government's debt limit fight. Let's bring in Yahoo Finance's Rick Newman to break it all down. So is this the beginning of real negotiations? Is this a non-starter with the other side? How should we read this?
It depends what happens next. So we can go through the list of what's in this proposal, but that matters a little bit less than whether House Republicans can actually pass it. So the way to kind of watch the way this plays out is if House Republicans can actually pass this bill, and a vote is likely by sometime next week, then it will give them more leverage to negotiate with Democrats who control the Senate. Now, there's no chance that even if this bill does pass the House, that it will pass the Senate because Democrats control the Senate. But if Republicans in the House can demonstrate, yes, they are unified, yes, they basically all agree that this is the right approach, and they can pass a piece of legislation in the House, then that will actually force Democrats in the Senate to begin negotiating. If they can't pass it in the House, then it just like Republicans are in disarray. They can't agree among themselves, and the ball remains in their court. They're the ones, Republicans in the House, remember, they're the ones who are saying we're not going to agree to lift the debt ceiling. So they have to demonstrate that they can come up with their own plan. And that's basically what this is all about. Again, a vote expected on this next week, probably late next week. So that's when we will know what happens next.
And as we've talked about this whole time, as we've been watching this unfold, Rick, we've been talking about the markets obviously are not pricing in that this could potentially happen, right? That a default could happen, that something could go wrong with this. Is there any, like, how should people be thinking about that?
I wish I could just tell everybody, ignore the entire thing because it's just political theater. It is, but there's always a chance that something goes wrong. So I think the reason that the markets are not pricing in anything that would even remotely resemble the U.S. defaulting on its obligations is that every time this has happened before, there has been some kind of resolution. Now, this did get really ugly once. That was back in 2011. When it went right down to the wire. I mean, literally within a couple of hours of the U.S. actually having to default. The stock market really did go down by about 10% leading up to that, and it took about 6 months for the market to recover its losses. So that's one instance where it did have this whole stupid process over raising the debt ceiling did have a material impact on financial markets. But all the other times, it has gotten resolved, yes, at pretty close to the last minute, but neither political party wants to be the one voters blame when we have this complete catastrophe that the U.S. Actually defaults on its obligations and the entire financial market worldwide goes haywire. So that's why this is not, a default is not priced in. But these politicians in Washington are going to force us to pay attention to this stupid drama all the way up until till pretty close to the last minute. And one other thing I would point out, guys, we don't know exactly when the date will come when the Treasury literally runs out of money and it does not have enough money to pay everything it has to pay. But there's some indication it could come sooner than we have been expecting, and that is because tax receipts, as people are finalizing their taxes, are coming in a little bit lower than expected. So that means the Treasury has less wiggle room, less kind of cash flow coming in. And this could come to a head as early as June. Some analysts are now saying before this, they were thinking maybe late summer or early fall. So this could happen a little sooner than we think.
Yeah, somebody's going to have some explaining to do, especially with, about 19 months until the next general election as well. People got receipts, right. Rick. Thanks so much.
See you guys.
All right, switching gears here. IBM is out with its latest results. The company beat on earnings in the first quarter, but posted a slight revenue miss. It said its full year free cash flow, a metric that the street was watching very closely, will still come in above estimates. Now, IBM's software and consulting revenue both rose in the quarter, while its infrastructure revenue fell 4%. IBM's CEO played up the capabilities of its own AI platform as all industries face pressure to implement this technology. We'll dive more into these IBM results later on in the show and tell you everything that you need to know deeper about some of the details we outlined just there. Well, it's time now to dig into the latest Yahoo Finance morning brief, and today we're taking a look at how markets continue to pay no mind to the "Don't Fight the Fed" motto here. And for more on this, with the disconnect between investors, we're going to have more on this on the other side of this short break on the morning brief. Stay tuned. Welcome back. Time now to dig into the latest Yahoo Finance morning brief. And today we're taking a look at how markets continue to pay no mind to the "Don't Fight the Fed" motto here. Now, there's been, of course, a lot to dive in on this. And for more, let's bring in Julie Hyman, the author of today's morning brief.
I wrote about this today. Don't Fight the Fed has been around since 1970 when an investor wrote about it in a book. And effectively what it means is that Fed policy has a lot of effect on what happens in stocks, but people have fought the Fed or sort of gone counter to what you might think for Fed policy, basically since the beginning of the markets and the central bank. And the Fed is a lot more transparent now. We know a lot more about what it's doing, but the market doesn't always believe what the Federal Reserve says it is going to do. Witness the so-called dot plot. All the dot plot is the Fed members' predictions of where they think rates will be at a given point in time, the so-called terminal rate, if you will, of this current cycle. So in December, each of the Fed members is represented by a dot, gave us their forecast for where they thought rates would end 2023. And most of them were clustered between 5 and 5.25% in that range, right? If you look at the March projections, it's pretty much the same, right? You see most of the dots clustered in that region. So effectively what that implies is that there would be one more quarter-point rate hike before the end of this year. Does the market believe that expectation from the Fed? Not if you look at swaps markets and futures markets and how they price in probability for what the Fed is going to do. We use the CME Fed Watch tool to sort of try to pin this down and get an idea of this probability. The day after the Fed released that on December 14th, that dot plot, here's where the probability stood for the end of 2023. So they were in line with the Fed's own predictions, only 3%. In other words, only 3% of bets being put down were agreeing or believing what the Fed projections were at that point in time. Most of them were clustered at lower places. What about now? With the Fed still clustered around 5 and 5.25%, guess what? They still don't really believe them. So the probability now of that is 8.8%. And to be sure, this number fluctuates quite a bit, right? As of yesterday, it was something like 11%. Earlier this morning, it was something like 6%. So it bounces around a bit, but it's been pretty consistently below 20%. So if you look at 475 to 5 at 27% probability, or if you look at 450 to 475 at 37%, to put all of this in perspective, essentially what this means is that most bets being put on in the market right now imply that the Fed will cut rates before the end of the year. We have seen stocks rally, for example, in part based upon that view. But is that view correct when the Fed itself is telling us that's not what they're going to do? Well, let's talk about this more, Brad, shall we?
Yeah, with the disconnect between investor expectations on rates and the Fed's hawkish tone comes a level of market risks. And here for a deeper dive on this and more, we've got Charles Schwab's senior investment strategist, Kevin Gordon. Kevin, thanks so much for taking the time.
Morning, guys.
Absolutely.
Good to see you.
So let's dive into this. I mean, because Julie was breaking down that disconnect. She wrote about it in today's morning brief. And why do you think that disconnect currently exists? Why are investors perhaps more optimistic in seeing some type of cut and betting based on that versus what the Fed is communicating?
I think it's still, well, there's a couple of fights going on in markets, which is interesting because you have the bond market clearly fighting the Fed, assuming and expecting that there will be rate cuts this year. And then the stock market, in a way, is fighting it, as you were mentioning, Julie, with this expectation that somehow, number one, cuts this year are going to happen. Number two, that would be bullish. I don't really know how that's the case because especially with this particular Federal Reserve, how much they want to keep policy tight, stay at a restrictive level for some time. A turnaround after they get to the terminal rate, whether that's in May or after, a quick turnaround to cuts, in our view, would only happen in the context of pretty dire economic and or labor market data. And at the outset, that's not bullish for risk assets. It's certainly not bullish for stocks. So I think that's probably the disconnect. And it's a little bit ironic, too, because even if the market sort of is right in pricing in cuts, as I was mentioning, it's not a good backdrop sort of at the outset. So maybe, in the future, once you get to, the sort of zero lower bound, not zero rates, but kind of the lower bound of the Fed's rate cutting cycle. But at the outset, I don't think that's a positive backdrop.
And so how does this kind of set stocks up this year? If you're fighting the Fed in those various different ways, does that then mean that there's a decent amount of more risk of more downside?
Yeah, I think that the disconnect will be a volatility driver. I'm not sure it's going to look the same as it did last year because you have to keep in mind, the tightening in financial conditions that the Fed's looking for this year, I would argue is actually a little bit different than it was in 2022. I think last year it was more kind of the market-based financial conditions data, all the indexes that we track, but they're more markets reliant. I think this year, and particularly what happened in early March, it's much more of a credit story and a real economy, financial conditions story. Most recently, members of the Fed, including Austin Goolsbee, who's the newly minted Chicago Fed president, has been talking about that, where there's an expectation that you start to see a tighter credit environment, more restrictive lending standards, which we already saw going into SVB. But with that expectation, the lags are still in process and still working. It's just harder to see. I think it's easier to see on a day-to-day basis with market data, but we just have less clarity now, and it takes a little bit of time to feed through. So in our view, that's kind of the story of the market maybe moving away from inflation-based data and kind of more into real economic data, i.e. the labor market, as kind of the next driver, of volatility in this year.
Yeah, and credit is also something we've heard some Fed officials start to talk about. I believe John Williams, New York Fed president, spoke last night and talked about that. We've got more Fed officials talking today. And on the topic of financial conditions, your colleague Liz Ann Saunders tweeted a chart of financial conditions yesterday, which are actually now loosening again. I mean, it makes sense they would be loosening to some extent after the big tightening that occurred in the wake of SVB's collapse. But that chart does not support the Fed stopping.
Yeah, and that's the hard part is you have a real kind of real-time metric like that, and that's more market-based, which is the tough part that, year to date, financial conditions in a market sense, they've eased because you've had equities rally, you've had yields not, move back to their highs, and then the dollar is eased as well. And then the step down in sort of the size of rate hikes from 75 basis points last year to now 25, that has all contributed to an easing in financial conditions in a market sense. The hard part for the Fed is that their bet is for this year, the real economic data start to tighten and get worse, but that takes longer to feed through. And, policy we know acts with a lag, as you were saying. I mean, I don't think it's a coincidence that a full year after the Fed started raising rates, you had 2 major bank failures. So I think that you probably have more to go, not necessarily maybe on the banking side, because they did a lot to sort of stem the bleeding there, but probably on the consumer side, maybe on the labor side. And, we have to keep in mind, that's a feature of what the Fed is trying to do. It's not a bug. They really need to see more softening in the labor market, which they haven't seen, I would argue, to the degree they want. Even on the inflation side, I don't think that they've seen a lot of progress, which they've been telling us. But you need both of those components to work in order to get to, closer to what their goal and what their estimate is for this year, and it hasn't happened yet.
Okay, so for a portfolio strategy perspective now, how does an investor, I guess in two ends, an investor that still says, you know what? I'm going to put my boxing gloves on. I'm going to try and fight the Fed. Mm-hmm. How can they perhaps best mitigate some of the risk that they're going to be taking on in that? And then on the other side, for someone who says, you know what, I'm going to listen into the Fed. I'm anticipating the moves that they're going to make, paying close attention to that. What is the sector play? What's the strategic play for them?
Yeah, so I haven't approached it as much from a sector-based view, which we've all talked about a lot. But from a factor perspective, I think what's really nice in this environment is that you can pick. You've all been talking about kind of pricing power and the ability to withstand higher margins in this environment. It hasn't been easy for a lot of companies. So with the number of companies exhibiting that quality shrinking, continuing to shrink, that's been the case since kind of early last year, you want to look for companies that have those qualities. And the nice part is that you can apply that across sectors. So I'd pick, the tech sector, for example. It's kind of the most talked about. Even within a sector that's done really well year to date, you've had the best performers in that sector with the strongest profit margins, and the worst performers have the weakest. They also have the highest leverage. They have the lowest interest coverage ratios. So even within a very large sector tends to drive the market more often than not, you can have a pretty wide dispersion in performance that way. So I would think of it in the Fed perspective that way. From a recession, point of view, if we do go into one this year, which, we think this ultimately turns into a more formal recession, I think you still have to be choosy and pretty, picky in what you're looking at, because the traditional defensives like staples or utilities, some of those benefited a lot from the wave of inflation that we saw, and the revenues haven't yet corrected down, and they haven't corrected on the hiring side too. So keep the cost dynamic in mind when you're looking at those names too.
Yeah, good point, considering inflation and all of the rest of the dynamics too with those kinds of names. Thank you so much, Kevin.
Thanks, guys. Good to see you.
Good to see you in person. Kevin Gordon, Charles Schwab, Senior Investment Strategist. Well, we had the opening bell on Wall Street just a moment ago. Stocks opening in the red here today. The Nasdaq once again leading the way down. It's down 0.7%. Of course, Tesla part of that. The S&P off about 0.6, and the Dow off 0.4%. A lot of earnings out today and pushing those indices around. What sector action you looking at there, Brad?
Yeah, taking a look at the 11 S&P 500 sectors as of right now. Utilities, the only bright spot. It's up on the day by about 0.2%. Of course, we are early in today's trade. Here in the first 5-6 minutes, you are seeing consumer discretionary pull up the caboose right now. However, year to date, still holding on to gains. Yeah, we get that. But here today, right now, down by about 1.2%, along with 10 of the other S&P 500 sectors here. So some of the other major decliners that we're seeing: energy, communication services. We're going to dive into some of the AT&T earnings as well. And then additionally, technology, you're seeing that down by about 0.7% here on the day. Those some of the larger decliners here. I want to take a look at the tech-heavy Nasdaq as we're zeroing in on some of the major cap tech companies. Apple, you're seeing that open lower here today by about 0.6%. Microsoft also down by about 0.8%, fractional declines for Amazon, Nvidia, and then Meta down by about 1%. And Tesla, here after they had reported earnings yesterday, and of course the earnings call, which was largely lackluster after the bell yesterday. Tesla shares are now down by 7% here in reaction to what the street really had to digest in both commentary and the actual Q1 figures that were reported, plus some of the forecasts too, Julie.
Can you call up trending tickers real quick?
Sure
because that'll just give us a really quick kind of shot of some of the companies out with earnings that people are really watching here. Because I know that obviously Tesla's going to be on that list, but like AT&T, American Express, IBM, Las Vegas Sands, a lot of these companies out with earnings. So it's a busy day. Just kind of illustrates it's a busy day.
Absolutely. Taking a look at IBM, and we'll dive into that just a little bit more.
Yes, we're going to do it right now, as a matter of fact, Bradley. That worked out well. IBM shares are up about 1.5%. It sees modest full-year revenue growth and does still see free cash flow at $10.5 billion for the year. That is above what analysts had been estimating here. And the company says sales are going to increase 3 to 5% this year, in addition to affirming that free cash flow forecast. You see there the numbers last quarter, revenue missing a little bit, earnings beating as well. And the CEO, Arvind Krishna, did tell Bloomberg that there was some softening going into the end of the first half, but he thought that growth would improve at the end of the year. There's also sort of the support of the dividend yield for, even for a company like IBM, which is kind of interesting here, that there is that impetus for people to look at the stock because of it.
You know, for companies like IBM, there are perhaps no two sexier words than artificial intelligence this earnings period as well. And they talked about that. They certainly are leaning further into the AI kind of landscape and a lot of the fodder for conversation. They actually made 3 acquisitions over the course of this most recent quarter. In the first quarter, really trying to extend some of their capabilities, particularly in hybrid cloud and AI they mentioned, and particularly in AI, they're projecting this, or at least believing that this is going to add $16 trillion to the global economy by 2030, and also reminding that AI for business far different than kind of generative AI for search, even some of the consumer functions out there. But that's something that they had to say on the artificial intelligence front.
Yeah, that is an interesting point, because while all of the buzz and the zeitgeist has turned towards the large language models, ChatGPT, et cetera, IBM, which has been doing this for a while, has not been as much of the conversation. Is that an issue for the company? As you said, it's arguing no, but I guess we'll see if any of its clients do turn. I mean, certainly, there are business applications of the newer kids in town as well. Yeah,
largely on the cybersecurity front. They've already had a hand in that game on the artificial intelligence front. I've actually seen some of their artificial intelligence in person. They give some tours around the U.S. Open, actually.
Cool.
A couple of years back, I was able to check that out. And
nice.
It's remarkable how many people are trying to hack into the U.S. Open data. It's
Scary.
tennis, guys.
Scary.
It's tennis.
Let's talk about Taiwan Semiconductor. The company forecasting a revenue slowdown in the second quarter. That's after posting a surprise rise in net profit in the first quarter. And the shares, which were earlier down, have now turned higher by about 4%, which is quite interesting here. That's even after that worse than expected revenue forecast. Remember, this is a main supplier to Apple. That's one of the reasons why we look at TSMC. We also look at it as a sort of bellwether for the rest of the chip industry because it does make so many of the chips that other companies design. So it's interesting here. I'm kind of surprised to see that it's turned higher now.
Yeah, one of the quotes from the company's chief financial officer, Wendell Huang, he said this on Thursday, that moving into the second quarter 2023, they're actually expecting their business to continue to be impacted by customers' further inventory adjustments there. And worth noting that this was the most minimum growth, at least on the quarterly earnings front, over the past 4 years. So that particularly noteworthy here. But as you mentioned, yeah, a major Apple supplier.
Yeah.
And of course, as the chips landscape is changing, so much of the focus has come down to something that Taiwan Semiconductor had really cornered off for a while, which is the fabrication process. And now as Intel, now as other operations are coming online and really ramping up that production and capacity, I think Taiwan Semiconductor could be facing, at least in these next kind of this interim period of time while that comes online, just trying to retain some of the existing customers that they do have.
Maybe. I don't think anybody's too worried about Intel breathing down their neck quite yet. That's a ways down. One more thing I just wanted to, or a couple more things I wanted to mention. The CEO of Taiwan Semi did say that they were passing through the bottom of the cycle in the second quarter. So maybe that's one reason for optimism here. A couple other things to mention. ASML also came out and kept its full year CapEx target. And we also heard from Lam Research, which came out with its numbers as well. And ASML shares up just a little bit. Lam Research shares doing better. They're up by about 5% today.
All right. We're also zeroing in on AXP shares this morning. While American Express reports quarterly record revenue, the company braced for debt struggles among credit card holders, weighing on some profits there. You're taking a look at shares here this morning, down 5% in reaction to the earnings results that came out. And the revenue came in at $14.28 billion. That part of the record revenue that we were mentioning a moment ago, and really driven, at least mostly here, by increased card member spending. There's a kind of larger question, even as I think forward to what we're expecting to come from the New York Fed in their quarterly report that relates to credit card and household debt as well. I think if you do continue to see consumers clearly lean into their credit card spending, it's because they can't deploy cash at the same expediency or with the same comfort that perhaps they would have leaned on that in the past. And for businesses, because American Express is kind of more of a gauge into how businesses are also
and higher income consumers as well.
Exactly. And so where some of the appetite to spend is either just leaning further into, hey, just put it on the plastic for now and we'll figure it out later, or for some of the business clients out there, where on the other side of that, you might be seeing some of the T&E start to pull back a little bit as costs are being restructured too.
Yeah, so on the two sides of that, you had the purchase volumes go up. I think 14% was the increase. And on the other side, the provision for loan losses, $1.1 billion, which was higher than expected. So that sort of captures that thesis that you're talking about, that people are maybe putting more on the card, but at the same time, Amex is preparing for maybe more of those loans to go sour. Our Brian Sozzi had the chance to hop on the phone with Amex CEO Stephen Squeri, and he talked about that earnings might have missed the street's expectations, but they didn't miss their expectations. He also talked about SVB and its collapse. He said, well, I was going to read that. What will be interesting here is that we had a too big to fail scenario in 2008. You may now have a situation where you're too small to succeed. Since SVB, we've had more inflows to us, which makes sense. Like many financial institutions where that has happened. Yeah, he also added that the economy is definitely bifurcated and thinks that at the lower end of the economy, seeing some stress, but we just don't have that. But the provisions might say a little bit otherwise, at least for right now. Yeah. Yeah. We're also watching shares of AT&T this morning. Got to check in on the telecom company. Sinking after a mixed report showed a slowdown in postpaid phone subscribers. We're going to speak with the telecom giant's CFO in the next hour, so stay tuned for that. Coming up, regional banks are in the spotlight this week after wrapping up earnings. Jared Blickery has the breakdown there next.
Welcome back to Yahoo Finance Live. Let's get to Jared Blickery at the Wi-Fi Interactive. We teased, Jared, some of those regional banks. So what are we seeing over the course of this week?
That's right. It's not just Tesla earnings, it's the regional banks as well. We have about 5 or 6, and it's really depending on size here. That's one of the things that I'm noticing, and it comes down to deposits. So some of the larger banks having an easier time retaining and also obtaining deposits, and that's what we're seeing. Truist Financial Corp, Fifth Third, and that's this stock here, TFC and FITB. Those deposits were broadly stable. Truist call with the analyst CEO Bill Rogers saying he's truly optimistic despite increased uncertainty. CFO Mike McGuire said he expects net interest margin to dip again in the second quarter. Net interest margin is a profit center of banks. Basically, they want to buy low and sell high. That's the cost of money. They're not always able to do that, but broadly, last quarter had a bit of a downstep end, as you can imagine. Not very surprising there. Also, broker deposit was a big thing. A lot of banks can buy broker deposits. This is hot money, people looking for that higher interest rate. I think a lot of us had done that ourselves, but CDs of over $100,000, those are way up as well. And when we're seeing some misses here, KeyBank, Comerica, Zions, each of those banks down about 4 or 5%. A lot of that has to do with the deposits too. Comerica's $65 billion in deposit that did miss estimates. Comerica did increase its cash positions. Basically, I'm not seeing any huge fallout here, but in general, there's going to be a lot of hot money flows around the economy whenever we're talking about tens, if not hundreds of billions, if not trillions of dollars sloshing around. You're going to have a few disruptions there. It affects leverage. When you don't have leverage, you're not able to buy those stocks and ramp them. So all in all, this is a very important part of the earnings picture today. Just saying there is still a little trouble out there, but it's not a disaster, guys.
All right, that sloshing around, not as fun as in a pool in July. No. Jared, thanks so much. Appreciate it. Guys, coming up, tracking Tesla shorts. We'll break down why the EV maker is the second most shorted stock next.
Short sellers might be making some money this morning on Tesla. They're still watching squeezed margins take their toll on the company. According to S3 Partners, the stock is one of the most shorted, second only to Apple. And here to talk about how shorts are reacting to Tesla's recent earnings report is Ihor Dusanusky, S3 Partners Head of Predictive Analysis. Ihor, good to see you. Talk to us about how the shorts were positioning going into this and what you're seeing, if anything, in the wake of the numbers.
Well, beginning of the year, December of 22, Tesla short interest was down to $8.6 billion. It's gone back up to the $16 billion range. But over the past month, we've seen 3.6 million shares covered, around $600 million worth of short covering in the name. People were covering ahead of earnings.
Is there any clear reason why some of the short sentiment continues to persist around Tesla?
Well, it's a tech stock that's kind of the bellwether for the group. So it's got huge volatility. Short sellers like the volatility because they can get a big bang for their buck when the stock goes up or down in these big jumps like we're seeing today. If you're on the right side of the market, you really make a great return. But it's really a tech short. You're shorting this instead of shorting 20, 30 other stocks. You just short Tesla.
I'm curious, Ihor, we've talked to you before about the dynamics for smaller companies when there are short squeezes. With something the size of Tesla, do you tend to see short squeezes because of the size as well of the short interest? Or how does that dynamic work?
Yeah, technically, when you have this big a stock, it's really hard to squeeze. But bottom line is a squeeze occurs when short sellers lose money. That's the only reason you get out of a trade. So when you see these huge losses, you'll see people getting squeezed in the stock, and short sellers will cover. The thing with Tesla that's interesting is that when one person gets out, another person gets in. It's kind of like the WWE. You keep getting tagged in, and that's why we see short interest levels so high, because someone who's lost 20% of their trade gets replaced with someone who says, oh, this is a good price for me to short because I think it's going to come down from here.
Okay, and so as we're taking a look at Tesla kind of over these past 3 months, it's been one of the stocks that has taken off over the course of this year thus far as well. So all of that considered, does that just add more to the short profile when you do have a bounce back like Tesla has seen over the course of 2023 thus far?
Yeah, shorts are down almost $6 billion in mark-to-market P&L this year. So they're taking it on the chin. I think right now we're down 6%. So shorts have made back around $1 billion of that loss just today. So you're going to see some new shorts coming in saying, I think the price might go down further, but you're going to see some people that might be covering their position saying, well, I made back some money or I made some money and I'm willing to cut my trade and take my profits.
As we mentioned, Tesla is number 2 on the list. Apple is number 1. And is this just a function of what you were saying that, there tends to be a relatively high level of short interest in large cap tech, or is there something else going on with Apple?
A little bit of both, but really it's the tech stock. So I can short the QQQ ETF, or if I want to have an idea of covering part of my tech portfolio, I short Apple. And as you can tell over the past several years, Apple short interest has really gone between $14 and $20 billion. It hasn't really gone that much higher. It's really a fundamental institutional short.
How much of the additional kind of short, and I guess if you're looking at the broader profile of how retail investors have really popped up over the course of the past 3 years, how much of that is driven or correlated to that new wave of investors as well that have made their way in and are clearly staying involved in the market in some capacity or another?
And Tesla's a great point of interest in this because we have our new Black Mac product, which looks at the long side of the market besides just the short side that we've been known for. So Tesla's got 34% of its long shareholders are held by passive investors, your BlackRocks, your Vanguards. 11% are held by active investors, your hedge funds and funds that trade often, which means that over 50% of the stock is held by non-institutional people, non-institutional investors. So really that's the retail guys and the smaller investment groups that are holding this long. So they really drive the market, drive the price in Tesla. That's why you have a lot of support in some prices and you have these big moves up and down. If the retail investor gets scared, they pull out and they move the price in big jumps.
Well, that's what we're seeing today to some degree. Ihor, good to catch up with you as always. Ihor Dusanusky is S3 Partners Head of Predictive Analytics. Thank you.
Thank you, Amy.
Coming up, housing market forecast, why our next guest is predicting a 10% price drop in 2023.
Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We've been tracking, of course, markets here this morning. We're about 30 minutes into trade, and as of right now, all three major averages are in the red. The Dow lower by about 190-ish points, by about 0.5%. We'll round that off to on a percentage basis. S&P 500, that's down 0.6%. Nasdaq Composite down about 0.5% as well right now. 62 points in the red for the tech-heavy average. But we've also got some breaking news this morning at the top of the 10 a.m. hour on housing data. For that, I'll toss it to you, Julie.
Yeah, existing home sales falling by 2.4% month over month to an annual pace of 4.44 million. That is worse than the 1.8% drop that was estimated here. So, and falling from a pace of 4.55 million in the month of February. So definitely seeing some weakness here after what had been a big jump last month, seeing that weakness come back to the fore. So I'm trying to call up here the release from the NAR of the existing home sales data to see exactly what went on here, because it's interesting to come into the spring selling season and see this kind of result, right? Yeah, absolutely. I mean, typically in the spring season, as you're kind of ramping up for what would be some of the open houses, some of the, of course, different type of home sales spurring that would be taking place. I think for the results that we're watching come in here and the headline figures that you just ran through. I got the release.
Oh, you do have the release.
It was taking a second to load here. Yes,
too.
Exactly. So now, as I said, we saw that decline, and it declined in steady in the Northeast, declining in the other three regions of the U.S., all regions posted year-over-year decreases, even if the Northeast was fairly steady on a month-over-month basis here. So it looks like, I'm just trying to look at some of this other data here to see exactly what was going on, but we'll take a little more time and dig into it. But in the meantime, let's also get an economist's view of what is going on with housing, with the Fed expected to keep interest rates elevated through 2023. Our next guest says the housing market will likely be in a recession through this year. Abi Omodumbe is a PNC senior economist. He joins us now. So these numbers aside for a moment, although they weren't great, housing recession this year. Talk us through that thesis. Is it going to happen? When is it going to happen? And what does that look like?
Thanks for having me. Like the housing market has been in a downturn since fall of 2022 due to elevated mortgage rates. We expect mortgage rates to remain elevated through 2023. And also, consumers are very concerned about the economy. Consumers are concerned about high inflation, about rising interest rates. And we expect the downturn, which started in fall of 2022, to continue through 2023.
And so with this kind of combined with where financial conditions currently sit and the prospects for financial conditions, is it going to be easier or harder for people who are looking to get into the housing market to get a loan that not only they qualify for, but is also on favorable terms for them over an extended period of time?
So financial conditions will likely tighten in 2023. We do expect the Fed to raise the Fed's funds rate by 1/4 percentage point when they meet in 2 weeks. And also, after the bank failures in March, many banks are likely to be more cautious. So we might see some tighter lending standards. So we are forecasting that we are going to get a 10% decline in house prices this year. There will be more of a balance in the housing market. There will be less demand and more supply, and that will contribute to the decline in house prices, which we're currently forecasting.
And as we know, the housing market is really different region by region. Even what I was just talking about for this past month's existing home sales, right, that the Northeast was fairly steady, the other regions fell. When you look at that 10% price decline, what does that look like sort of region by region? Or is that, more the average everywhere?
All right, so we saw massive price increases in, many areas in the West, right? So think of Boise, Idaho, San Francisco, San Diego. Those were clearly unsustainable. So I think we're going to see bigger increases in the Western states. And also just on a month-over-month basis in recent months, we've been seeing bigger declines in the Western states compared to the Eastern states. And I think that is likely going to continue through 2023.
And so additionally here, let's talk about some of the housing starts and permits particularly, because they fell in March, and some of them really driven by declines in multifamily segments there. Where do we expect that to begin to balance out?
Right. So we saw big declines in the multifamily segments, but we actually saw big increases in single family starts. So starts were actually up for the first quarter of this year. But I think that's, for the rest of this year, we're likely to see a decline in starts due to higher financing costs for home builders. We've seen an improvements in home builder sentiment in recent months, but it's still below the key break-even measure of 50. So home building conditions are still bad. I don't expect there to be a substantial improvement of that this year. So I think we're likely to see a decline in starts and permits through the end of this year.
Abby, what does all of this do for home ownership rates? This is a conversation that Brad and I have frequently, right? There's especially sort of millennial home ownership and affordability, et cetera. Is this drop, even if it's not a great thing for the overall economy, does it allow more people to get into the housing market?
I think, home ownership has been difficult for a lot of folks, particularly first-time home buyers, given the big increases in house prices, which we've seen, particularly, since the pandemic started. I think that's, conditions will be more favorable for first-time homeowners this year, particularly because of the declines which we're expecting. So I think that we are going to see, more of a balance this year. We're going to see weaker demand due to higher financing costs. We're also going to see more supply come online. So we're going to see a lot of new construction that's going to come online, and that's potentially going to be beneficial for first-time homeowners.
What's the correlation that you're seeing, Abby? And I mean, even as we think about first-time homeowners, and I, as a millennial, kind of initiate my frowny face sequence because I'm just trying to get into that cohort of people who do own homes. Living in New York makes that harder. But anyway, at the end of the day, where should I be going to? I mean, a lot of people were talking about the regionality of where some of the inventory that's coming online is shifting, where some of these sales are shifting to as well. How is that correlating even with what we're seeing on the employment situation front, where you've got people who are looking to still maintain employment, but at the same time look for more affordable terms that they can live within, regardless of where that may be in the country, as long as there is a job available for them? How do you kind of compare the two together and meld the employment situation with the housing data?
Yes, so I think that's after the Great Recession. One of the reasons why we had a Great Recession was because, we built too many homes, but we've had very tight supply for the past decade. So I think that, there will need to be, some improved supply in terms of new construction. And I think that's where new-time homeowners, will be able to, tap into that. They'll be able to probably buy once we see improved construction of new homes, and which we expect. So I think that as inflation moderates and as supply chains continue to improve, we're going to see more construction come online, which, again, will be favorable to new homeowners.
Abby Omodumbe, who is the PNC senior economist. Abby, thanks so much for the time here with us this morning. We appreciate it.
Sure. Thanks, Brian. Thank you.
Absolutely. For U.S. household balance sheets, they're in great shape, according to today's chart of the day, which shows the ratio of liabilities to net wealth has fallen 50% since the 2008 financial crisis, and household leverage is at levels that were last seen in the 1980s here.
So this kind of speaks to also the ability or not of people to buy homes right now, right?
Well, somewhat, yeah. And I think for the household balance sheets and what we've heard from, that household balance sheet, of course, balances, no pun intended, or at least redundancy intended, a few things. It balances everything from what the debt levels are currently sitting at, because certainly if your balance sheets are still really looking at how much you're bringing in, how much is kind of a free cash flow positive scenario, and how much you're being able to save at the same time. Even all of that considered, you still have the household debt. There's good debt, there's bad debt that each household has, whether that's on the credit card front or whether that's on how much you're being able to pay down in your payments towards things like mortgages, seen as good debt, because ultimately that's something that you'll eventually be able to take full ownership of and recognize. So I think as we get the data that comes in from the New York Fed, and I keep leaning on this because it's amazingly important to tell about the health of the consumer, or at least the mindset right now, based on their credit card and debt holdings right now, especially compared with charts like this that look at the balance sheet health, if you will.
I mean, seems like a good thing.
It seems like a good thing. All the banks are saying that too. All the banks are saying over the course of this week that the consumer is healthy right now.
Yeah.
But to what extent that health extends?
And how long will it last? Yeah. And speaking of how long will it last, in addition to existing home sales a moment ago, we also got the March index of leading economic indicators, which fell by 1.2%. Now, first of all, what's the index of leading economic indicators? It's basically what it sounds like. It is an index. It is a compendium of different economic indicators that are put together to try to more forecast what is going to be happening next in the economy. And that 1.2% drop was versus a 0.7% drop that was estimated. It's versus just a 0.5% drop the month prior. This is the March number that we're talking about, by the way. This is also, incidentally, the lowest since March of 2009. So if you're looking for a leading economic indicator, as we talk about, is there going to be a recession? Is there not? How bad is it going to be? This is not necessarily a number that you want to see.
Right. If you ask Bank of America, Q3 2023 is when they're expecting the recession to start.
Well, perhaps this would support that kind of view.
There you go. Also, everyone, coming up, Disney's battle with Florida Governor Ron DeSantis. It's picking up steam. Our own Ali Canal has the details on this next.
Some breaking news for you right now. SpaceX has launched its Starship for the first time, but encountered a failure mid-flight and fell short of reaching space. We saw an explosion in the air in the footage of it. SpaceX made its first attempt at getting this launch off the ground on Monday, but halted it due to issues with its valve. The company had been aiming to first launch the rocket as early as summer 2021, but faced a number of development delays and struggled to win FAA approval in a timely manner. The Starship is built to carry cargo and people eventually into space. It's crucial for NASA's plan to bring astronauts back to the moon. There was no one on this rocket ship, to be clear. Thankfully, this was an unmanned test. And in the days leading up to the flight, Elon Musk, of course, head of SpaceX, had been sort of managing expectations about its success. So just to put it in perspective there.
SpaceX tweeting out this morning, as if the flight test was not exciting enough, Starship experienced a rapid unscheduled disassembly before stage separation. That one of the, of course, more known coined terms. It sounds a little bit more scientific. Elon Musk has used that in the past, but they are going to continue to review some of the data and working towards their next flight test, it sounds like.
Exactly.
Switching gears here. Let's go to, well, let's stay in Florida, I guess. Well, Cape Canaveral, at least, is in Florida. Anyway, the battle of Disney versus Ron DeSantis escalating as the Florida governor continues to criticize the media giant's parks and properties. Yahoo Finance's Ali Canal has the latest on Disney versus DeSantis. All right, what do we know now?
Well, it seems like this battle is never ending, right? And DeSantis, he's been on a tour promoting his book, and he's basically using that to attack Disney every chance he gets, especially after Disney outmaneuvered the governor with his hand-selected oversight board, basically passing last-minute legislation that essentially renders this new board powerless. So that created a whole new set of problems. But on Wednesday, that board did make a move to try to regain power by eliminating a planning agency and transferring the responsibility for all future planning over to the board. On top of that, this move comes just 2 days after DeSantis threatened to develop land near Disney. Some ideas he floated was a state park or a state prison. That created quite a few headlines there. So it's been this back and forth drama for quite some time, all stemming over Disney's unfavorable response to the Parental Rights in Education Act, otherwise known as the Don't Say Gay bill, which bans education of sexual orientation and gender identity from kindergarten to 3rd grade. Bob Iger has defended the company's actions, calling DeSantis' policies anti-business and anti-Florida. So Disney clearly not backing down on this. In fact, last night, the company announced that it will break ground next year on a planned affordable housing development just a few miles away from the Magic Kingdom. And the timing of this was interesting because DeSantis and the board had just criticized Disney for the lack of affordable housing for its 75,000 employees. That is set to be completed in 2026. But before then, I'm sure the drama is going to continue.
Yes, and there have been some Republicans who have actually sided with Disney, or at least sided against DeSantis in this whole fight as well, which is interesting. In the meantime, while this is going on, Disney's reportedly moving ahead with job cuts next week. That's according to CNBC, starting perhaps with ESPN.
Yeah, CNBC reporting that ESPN will be affected by these job cuts. Bob Iger did announce back in February that the company is planning to slash 7,000 jobs by this summer. Those cuts at ESPN, it will include management. It will include on-air talent. Bloomberg also reported that the entertainment division is going to be affected with 15% of those workers cut. And remember that Bob Iger, he did say that these layoffs will happen in 3 waves. The first wave happened last month. This would be wave 2, and then the third wave happening right before the summer. And this is all in an effort to slash $5.5 billion worth of costs, including $3 billion in content costs. This coming as profitability has become paramount for investors. Disney really focused on improving its free cash flow. It's reorganized the business into 3 separate divisions as a result of that. And these layoffs are just a part of that greater effort as Disney tries to steer this company in a new direction.
We'll see how it goes. And we'll count on you to keep us posted. Thanks so much, Ali. Appreciate it. Coming up, Treasury Secretary Yellen is looking to improve communications with China. We'll speak with an expert on the state of geopolitical tensions next.
Apple has opened its first store in India, with its second store set to open on Thursday. The move comes amid a push by the iPhone maker to expand its market share in the region, as well as shift some production there as it shifts its focus from China. But its presence in China is still strong, of course, due to its extensive supply chain. Yahoo Finance's Ali Garfinkel has all of the latest details on Apple's diversification from Beijing. Ali, break this down for us, because, I mean, they're still going to be operating. They will still have ties in China, of course, and they report out Greater China as a business segment. But what does this India move mean?
So, Brad, there are a couple of things to note here. First, unequivocally, this is absolutely a big week for India and Apple and that story. Those two new stores are a big moment, as is the case for Tim Cook's meeting with Prime Minister Modi in India. That said, you're right. The ties to China will exist for a very long time. For instance, Apple back last year said it was moving about 25% of its iPhone production to India, which of course leaves a huge portion of it in China. Now, why? There are sort of a couple of pieces of the reasons that the exit from China won't necessarily be an easy one for Apple, if that's one they should decide upon. The first is pretty simple. It's actually a piece of history, right? Apple has been, I think I had someone describe to me Apple as the ultimate champion of Chinese manufacturing. And it's the sort of thing, that's not the sort of thing you unwind, because not only is there infrastructure, there are ties, there are government connections. It's the sort of thing where they have spent a lot of time together, Apple and China, quite simply. That said, infrastructure is another piece of it. One of the things to consider here, Brad, is that India's infrastructure is not as developed as China's, particularly when it comes to supply chain. So that's something that is going to take time for India to develop. So it's the sort of thing that even if Apple wanted to make the move tomorrow, India doesn't quite have the infrastructure to do it. And lastly is a concern for politics. I won't take you too far down this rabbit hole, but essentially walking away from China overnight is not only logistically impossible, it is politically impossible. That transition period, I had one fellow at the Brookings Institute tell me, is going to be very delicate. So it's the sort of thing that, yes, Apple will be very dependent on China for some time, but we will see them start to diversify. And I think it's also important to say why we got here. We're watching this kind of geopolitical shift in real time. I had one source tell me our cooperation with China is on the downside, and the fact that this is happening in the aftermath of COVID is also, I think, really important. Remember, Apple has had a lot of supply chain issues in China throughout COVID. For example, we saw the Foxconn factory protests at the end of last year, as was the case with the Shanghai mass COVID lockdowns. So it's the sort of thing, there is a lot of history there is a lot of backlog, but COVID kind of pushed things over the edge for Apple to move out of China. That said, there's also a very simple fact why India looks like a really good market. It is now the most populous country in the world, Brad.
Yeah, pretty straightforward there, Ali. And they're opening stores there and whatnot as well. India, though, of course, is only one market, big as it is. Where else is Apple looking to diversify as it looks away from China?
That's a great question, Julie, because there are actually a lot of other countries in the mix. For instance, a huge number of MacBooks are produced in Vietnam right now, as is the case for other products in Malaysia, Thailand. So India is going to kind of be the star, I think, for its sheer size, but there are definitely other countries in the mix, not only when it comes to manufacturing, but when it comes to other markets for Apple.
Thanks so much, Ali. Appreciate it. Coming up, AT&T showed mixed results after a slowdown in postpaid phone subscribers. We'll speak with the telecom giant's CFO next. AT&T shares are slipping today after the telecom giant reported slowing growth in postpaid phone subscribers for the first quarter. Although the number did beat estimates, it also saw free cash flow fall short of expectations. AT&T CFO Pascal Desroches joins us now alongside Yahoo Finance's executive editor Brian Sozzi. Pascal, it is good to see you as always. So as we said, you're seeing that slowing growth. Good morning. You're seeing that slowing growth in postpaid phone subscribers. It did beat estimates. But talk to me about that business in particular and sort of give us a temperature check, if you will, on it right now.
I couldn't be more proud of our team. I mean, this is the 11th straight quarter where we delivered over 400,000 net adds. And it's, the thing to keep in mind is overall, the industry continues to grow, coming off of two really strong years of growth. And not only are we growing subscribers, the thing to keep in mind is that you're also seeing the quality of those subscribers come through. We have among the highest ARPUs in the industry, as well as the lowest churn. All that is resulting in wireless service revenue growth of over 5% for the quarter, and the business grew over profits 8%. So we feel really good about the overall performance of that business.
Pascal, Brian here. Good to see you again. So the free cash flow.
Good seeing you, Brian.
Good to see you. Yes, the free cash flow missed estimates, but you came out here and reaffirmed your outlook for free cash flow. How do you see things evolving over the next 3 quarters to hit that point?
Here is the thing, Brian. Free cash flow came in right in line with our expectations. I said at the beginning of the year that I expected free cash flow to progressively get better as we made our way through the year, specifically because our capital spend was going to be front-end loaded, our spending on devices was going to be front-end loaded, as well as the annual incentive comp cycle. All those things make Q1 a low watermark for free cash flow. It will progressively get better from here, and it's really mechanics of the magnitude of those 3 disbursements. They normalize out during the balance of the year.
Hey, Pascal, Brad here. One thing that we're trying to get a better read on over the course of this earnings season as well is just the health of the consumer. We've had bank CEOs come out and say that the consumer is healthy, but one of the data points that you're kind enough to continue to give us updates on is what the delinquencies look like from your customers. Can you give us an update on that metric? What are you seeing among subscribers right now in their payment frequency and cadence?
Sure thing. Here's what I would say. We have actually seen delinquency patterns, bad debt, all pretty much continue to trend consistent with what we saw the second half of last year. So there is no discernible change there. The only change we're seeing modestly is a moderation of our growth. But when you take a step back, the industry's still growing. It's just a moderation in the pace of growth.
To get back to free cash flow for just a second here, because as you said, it was what you expected, but clearly it wasn't what the street was expecting. So is it just a matter of you maybe need to do a little bit of a better job communicating that trajectory, or what? How would you explain that disconnect?
Yeah, here is really clearly what happened. Our free cash flow guidance. We give annual guidance. We said it was going to be back-end loaded. Street estimates are $1.5 billion. We came in at $1 billion. 400 of the difference is really in the level of capital spend. And so you're talking about $100 million on a company our size. I wouldn't, it's not something I worry about. We're trying to manage this business for the long term and not quarter to quarter.
Pascal, I talked a little earlier on today with American Express CEO Steven Square, and he told me that he's seeing stress among lower income consumers. Do you see that in your business?
As we made our way out of the pandemic, we progressively been seeing that the lower income cohorts are more challenged, but still relatively resilient. And the thing to keep in mind as it relates to our business in particular, the critical nature of our goods and services are such that it will be something that consumers will be very reluctant to do without. So we're probably not as exposed as other sectors to some of the demands of the consumer.
Since we last spoke to you, Pascal, one of your competitors, I won't say their name, we'll be friendly here, spent a lot of money on a prepaid business in Mint. Were you involved in that deal? And that sure seemed like a lot of money to me. Did it seem like a lot of money for you for that asset?
Look, I'm not going to comment on what our peers have decided to invest in. What I will tell you is I'm incredibly proud of our prepaid business, both AT&T prepaid and Cricket prepaid. Our churn is remarkably low for a business that is prepaid. We have really attractive economics, and it's a very valuable business. We're happy with it, and we see no need to add to that.
At the same time, it sort of speaks to the attractiveness of that asset and that customer base in general, whether you're whichever prepaid brand that you're talking about. And it also speaks to get back to the low income idea, to the affordability issue. We have continued to see, pricing pressure among some of you and your competitors. Where do we stand on that? Is that what we can sort of expect for the foreseeable future?
I don't think I followed. Can you repeat your questions? I don't think I
Just
understood
in terms
it fully.
of promotioning on postpaid phones, are we expecting to see that similar cadence to what we have been seeing?
The industry has been competitive for some time, but I take a step back when you look at it. This was the best first quarter ever for our mobility business. We are growing our ARPU, and we are at among the very top in terms of ARPU for the industry. So any given quarter, there will be competitors in the market with special offers, but big picture, when you look at how we are managing this business for the long term, how we're evolving it, I couldn't be more proud with the results we're seeing in that we're growing ARPU, we're growing subscribers, we're growing revenues, and we're growing profits.
And so what does that mean for the marketing spend that you've continued to pull forward, or at least put forward rather, to try and attract new subscribers as well? You're talking about transformation progress and supporting margin growth, and that pulls us back to the conversation of where you're cutting out spend in other places or restructuring costs. Does that include continuing to trim marketing spend, or if not that, where else across the organization are you looking at cutting costs?
Here's what I would say on our marketing spend. We are competitive, but very disciplined. We've been very disciplined. We've had the same offers to both our existing subscribers and new subscribers. And that approach has worked incredibly well for us. And we're seeing the results of that in terms of lower churn in our customer base. And ultimately, that drives savings in costs. When you don't have to go out and replace subscribers because you are keeping your subscribers longer, I think that is the savings that is coming through. But we are being competitive, but we're being very disciplined at the same time.
Pascal, to the extent you could, March was a scary time for markets, consumers, to see people lined up outside of banks to get their money. I've never seen that before. Can you take us inside the C-suite with you and your CEO, John Stankey? When you see those things happening from a leadership perspective, what were your thoughts in mid-March while you watched this unfolding? And how do you think about leading differently, if anything, in the months ahead?
Yeah, look, it is a reminder that the last decade, we have been living on abnormally low interest rates and probably broader credit availability than has been historical norms. And when that happens, invariably, you see the repercussions in things like Silicon Valley Bank. For us, fortunately, we're in a position where we've taken significant actions over the last several years to delever our balance sheet, and 95% of our debt is fixed with rates on average 4%. And so we were very fortunate. We're in a very fortunate position that we didn't while we were paying close attention and making sure that we had ample liquidity, we were confident that we would be able to navigate no matter what the environment brought.
Pascal, where would you say that we are on the network enhancement and expansion front? Is it too soon for me to be asking about 6G? 5G was all the rage. It seems like that's a thing of the past now. That's so 2019.
Oh, look, I think 5G is still in the very early innings. I think there will be a whole host of services that are rolled out the next several years using 5G technology. So there are clearly people in our organization looking at 6G and what that will bring. But right now I'm focused on optimizing the true value of 5G.
All right, that's going to be rip
Get
your
this
face
guy a
off
6G
speed.
phone there, Pascal. Got to give him a 6G phone.
That is a rip your face off speed, Pascal, if I hit 6G within the next couple of years here. AT&T CFO Pascal DeRoches, as well as Yahoo Finance's executive editor, Ryan Sazi here. Thanks so much.
Thank you very much, guys. Great seeing you again.
Definitely. Likewise. Coming up, everyone, the future of vertical farming, how an expensive overhead could impact the industry. That's next. Vertical farming promises to provide a more sustainable, reliable way to produce food for the global population. The industry faces some expensive overhead, so just how practical is this alternative venture? Well, we're going to dive further into this, and joining us now is Irving Fain, who is the founder and CEO of Bowery Farming. Irving, great to have you here on the show with you. I have been able to try out, it's made it to my own grocery cart, some of the Bowery Farming lettuces. So I got to know, when you think about some of the sustainability and what goes into running the day-to-day operations of Bowery Farming, how does this differ from what has been tried, trusted, true for decades, centuries even?
First of all, it's great to be here, and I am happy to hear that you are a consumer of the product already as well.
Good lettuce, yeah.
It is the purest expression of produce. In fact, it is what came out of your grandmother's garden. But to answer the question, this is really not just the reimagination of farming, but it's actually the reinvention of the entire fresh food supply chain. And so at Bowery, what we're doing is we build warehouse scale indoor farms. We stack our crops from the floor all the way up to the ceiling. We grow in smart growing environments that allow us to grow 365 days of the year, independent of weather, independent of seasonality, under lights that mimic the spectrum of the sun. And on top of that, and there you have a picture of it right there, we are able to grow completely pesticide-free, completely agrochemical-free produce. So no herbicides, no fungicides, no insecticides. We grow more than twice as fast as the field. We get more cycles a year than the field and more yield per cycle. So we're over 100 times more productive than a square foot of farmland outside. And all the while, we use a very small fraction of water compared to traditional agriculture. And all of this is essentially enabled by not only robotics and automation that we design and develop, but also the Bowery operating system, which is software and hardware, artificial intelligence, computer vision, and sensor and control systems, which essentially monitor and maintain the entirety of our operations from before a seed is planted till when our product ends up in your grocery cart.
Irving, that does not sound like my grandmother's garden. Maybe it tastes like my grandmother's garden, but that bears no relationship to my grandmother's garden, which obviously is by design. All of that also sounds very, very expensive. And I'm sure, as Bradley can attest, who has purchased your product at the store, it's costly for the consumer as well. So how does the cost work over time? When do you start to get that down?
Well, so first of all, I think really important to know, like we sell today at or below the cost of field grown organic product. So we are comparative to and competitive to organic product that's coming out of the field. And the product that we're producing is a day to 2 days from when we harvest it to when it's delivered to the retailer, which means it is not only fresher, it lasts longer at our retail partners on the shelf. It lasts longer in Brad's or anyone else's refrigerator once it goes home. And it's also more nutritious because 50% of nutrition is lost from the time a product is harvested outside to when it actually eventually gets there. So you have a better product than the organic product at or below that price point. That's the first piece. The second piece is when you look at what we're building at Bowery, it actually is not comparable just to the outside field. It's actually the entirety of the supply chain. So we are taking out all of these different players along the way, all of the time, all of these steps that happen, and we are creating a safer supply chain, a simpler, a shorter supply chain, and we can provide much more surety of supply on top of the sustainability. So you change the entire cost structure because many of the middlemen and steps along the way now actually are completely, they go away.
I guess, I don't know, maybe I'm shopping in different grocery stores, but I have not found that it is necessarily cost competitive. Like I can buy a organic head of romaine at Whole Foods for $3. I'm pretty sure Bowery, if I buy a box of lettuce, is more expensive than that, no?
Well, so when you get in the packaged salad category, you usually see prices between $2.99 to $3.99. And that's exactly where Bowery plays, in that zone as well. So when you look at any of their packaged salad products, whether they're from outdoor agriculture, from other controlled environmental agriculture players, we sit right alongside that price point, and that $2.99 to $3.99 price point. So sometimes the loose leaf product, which you can find on the shelves, ends up being cheaper, but that's oftentimes lower quality product, lasts a shorter period of time as well.
How much of a kind of operation in square footage wise, kind of you're looking across warehouses and going into vertical farming there, how much of a footprint does that require in order to output what you've already scaled up to, and how much more do you feel like you need to build out at this point?
Yeah, you can think about these our farms is in some very small scale distribution centers. So, Amazon, for instance, builds distribution centers 1 million square feet. This is a fraction of the size of those distribution centers to produce essentially 100 times more on a square foot basis than you would get outside. And so you're not only much more efficient on the land side of things, but you're actually much closer to your point of consumption. So you're eliminating the food miles and the trucking that's required. As we said before, you're delivering a product a lot faster and with much more shelf life on it, which has retail and consumer benefits. The truth is, Brad, we're a fraction of the total market in produce right now. And I think that's what's actually interesting and exciting, because right now we are seeing more consistent disruption in agriculture than we've really ever seen before. The world has gotten much more uncertain and much more unreliable. And all you have to do is to look to the west coast of this country, where it wasn't too long ago that we were looking at and talking about the 1,200-year mega drought, and you couldn't grow crops effectively in the way that we had historically in Southern California and in the Central Valley or in Arizona because of how little water there was. Now, over the course of the last few months, with atmospheric river events and now a record snowpack in the Sierras, production out of the Salinas Valley is at a fraction of where it typically is at this time of year, because now that there's flooding and enormous amounts of water. And you can see these types of changes not just happening in the United States, but everywhere around the world. So this isn't just important from a sustainability perspective. This is important from a surety of supply perspective, because the existing system that we have today is already proving that it is not going to be able to stand up to the increasing variability that's coming from climate change.
Irving, the vertical farming industry is mostly known for lettuce, right, and other types of greens. But you guys and some of your competitors have also dabbled in some other types of produce. I know strawberries was something you guys were testing last year. Just want to know how that was going and what your sort of other produce ventures look like right now.
So we launched strawberries about a year ago. We've had a lot of success, been small launch so far, but we can't keep them on the shelf, which is always a good problem to have. I think berries are a really interesting category specifically. We've all had that experience where we get a strawberry in the off season and it doesn't taste like very much. It isn't very good. It may be extremely expensive as well because price variability fluctuates based on what's happening outside. And we're excited about strawberries, not just because of strawberries, but they're part of the fruiting crop family. So tomatoes and peppers and hot peppers and cucumbers and raspberries and blackberries. There's so much that shares similar attributes to a strawberry. And we've actually grown hundreds of varieties of crops from an agricultural science perspective. We haven't necessarily launched everything commercially, but when we look at the actual opportunity for what we can grow economically at Bowery, it's about $1 trillion a year global opportunity. So it's enormous, but certainly not all of agriculture. And I would never tell you that indoor vertical farming is going to take over all farming across the world. The only way we're going to get to a sustainable future in agriculture is many, many different approaches working together to solve the overall agricultural challenge.
Irving, finally, a question about the company specifically and a financial question, if you will. IPO plans at some point. I know it's not the best market necessarily generally, but just curious what your trajectory looks like on that front.
Right now we're just continuing to focus. We're fortunate we've got great investors, great supporters, and we're a private company today that's allowed us to continue to grow and build effectively. And for right now, we're continuing to grow and focus on building the business. And certainly this can be a durable public company when the time is right.
All right, well, we'll keep in touch with you and talk to you when that time is right. Irving Fain, founder and CEO of Bowery Farming. Good to talk to you.
Thank you.
Coming up, what's moving the markets? Our very own Josh Schaefer is going to have a full breakdown and a focus on one stock in particular.
Let's turn now to some big equity moves coming up on your lunch break. Las Vegas Sands shoring up its stock on a comeback story in Macau. Here's Yahoo Finance's Josh Schaefer with your stock in 60 seconds. Josh, you're on the clock.
We'll see how quick I can be, Brad. All right, so we got Las Vegas Sands beating on the top and bottom line for earnings. Adjusted EPS coming in at 28 cents per share. That's above street estimates of 17 cents per share. But as Brad mentioned off the top here, really the story is that Macau revenue. Macau revenue coming in for the quarter at $1.2 billion. That's the first time Las Vegas Sands has had quarterly revenue in Macau above $1 billion since 2019. You can see there nearly triple what it was a year ago. And that same story has basically played out in the stock here, guys. So if you take a look at the Las Vegas Sands chart over the last 2 years, you can see where it started dropping here. And actually, if I go back even further to the 5-year, you can see obviously the start of COVID-19 when there was a shutdown in China and people couldn't travel. The stock went down significantly. It has not returned to those levels because Macau revenue has not returned. But then you take a look at today, a significant bump today, up almost 7% as that Macau revenue seems to be moving toward the upside. And if I can just mention 2 other tickers here quick that are benefiting from the same news. You see MGM up 2% and Wynn also up more than 4%. Those 2 casinos also do have Macau exposure and exposure in China. They have not reported results yet, so we'll keep an eye out for how things are going for them as well.
Did you have your timer going?
You gotta get a buzzer for this, I think.
That seemed like it was pretty close.
You used to buzz us.
Well done.
Yeah.
Thanks, Josh. Appreciate it. And as we wrap up the show here, let's talk about what's coming up on Yahoo Finance Live. The notes are in for Tesla, and Wall Street is not impressed with Elon Musk. The price war eating into margins at Tesla shows it might just be a car company after all. Rochelle Akuf on Paz Subramanian will discuss.
Plus, TikToks and makeup stocks. L'Oreal just had a big quarter. Shares of ELF, ELF Beauty are at 52-week highs, and the reason might just be influencers on TikTok. Rochelle Akufo takes a deep dive into the industry.
And later, do not miss Jennifer Schomburger's exclusive and timely interview with Cleveland Fed President Loretta Mester. That is happening at 4 p.m. Rochelle has you for the next hour of trading as we see a sell-off in stocks continue.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. It turns out price wars do have consequences, even for the world's most valuable car maker, Tesla, taking a hit on its gross margins after repeatedly slashing prices. Elon Musk putting all of the blame on the economy. We'll discuss. Plus, up in smoke, cannabis stocks have not seen much green so far this year as regulation headwinds and piles of debt continue to hit the industry. We'll talk about the future of that space and what could come later on in the show. And finally, from TikToks to makeup, cosmetic stocks have been rallying so far this year. Why? Influencers on TikTok might be giving the space a boost. We'll talk about the trends and the benefits in this space later in the show. But first, let's check in on how the major indices are faring this morning. Still seeing some selling action here, though, still relatively flat, but the Dow there down about 44 points, the S&P there also down about 15 points. The Nasdaq taking the biggest hit, weighed down by Tesla and their disappointing results this morning. Let's also take a look at what we saw in the Treasury market as well, as we brace for more earnings, and of course we still await the Fed to give us what they'll be doing next month. We see the 5-year down about 2.7% on the day, the 10-year down about 1.9%, and the 30-year longest term yield down 1.2%. All right, let's start off with Tesla taking a tumble. Investors zeroing in on the automaker's shrinking margins as the price war it started takes a bite. CEO Elon Musk laying part of the blame on the macro environment. Here's what he had to say on the investor call. Take a listen.
It is worth pointing out that the current macro environment remains uncertain. I don't think I'm telling anyone anything people don't already know, especially with large purchases such as cars. And while we reduced prices considerably in early Q1, it's worth noting that our operating margin remains among the best in the industry. We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin.
Wall Street taking Tesla to task on their earnings. So is the stock a good buy or a good buy? Here with more, Yahoo Finance's Pras Subramanian. What do you think, Pras?
You know, it's really just a big bull and bear debate here, tug of war between people that think that the gross margin floor is the concern. They can't maintain that 20%. They dip below that to 19.3. This is a problem. The company is valued at a automaker with such industry-leading gross margins. So what do we do there? Versus the other side of it is that this is a mature company. They are looking at sort of a very uncertain macro, like Elon mentioned, and they're sort of navigating it correctly. And that's sort of what Gene Munster of Loop Ventures said. That he says that he's giving investors confidence out there that they're doing a good job navigating it. So that's kind of the debate there. But I think as of right now, the bears are winning. The stock down a lot today. There's a lot of concern about, is demand a problem? Is that why there's so many price cuts here? Can Tesla weather the storm? Are they going to be able to make up for these price cuts with more expensive subscription and software offerings? So we'll see if they can do that. But I think this is the question: is what's next for Tesla? Is it going to be this more mature company, not a high-flying tech company, but more of an automaker that sort of leads the way in EVs and is willing to take a profit cut in order to boost or expand their market share?
And that is the debate. I remember last year in February, Musk tweeting, Tesla is as much a software company as it is a hardware company, both in terms of cars and factories. He says this is not widely understood. But when you look at the behavior of the stock, does it perhaps tilt more in one direction than the other at this point?
I mean, right now it's tilting more down, a little bit being weighed down here. But let's be honest, the stock was up 50% in year to date before today's earnings. So there was some room for maybe some profit taking. People kind of wanting to lessen exposure on the uncertainty of what's happening as new competition kind of comes to the fore with new EVs, cheaper EVs. The Chinese market is very, very competitive. So I think that's the kind of concern with Tesla. But let's be honest. Elon Musk said that the Model Y was the highest selling vehicle overall in Europe and in the United States. We're not counting pickup. So there is some positives there. But I think right now it's the concern that the profitability is coming down, and that's going to kind of make the value of the stock. I mean, you mentioned the most valuable car maker. Is it still going to be that today or tomorrow, right?
Right. We'll continue to track that. It was an interesting story with Tesla. Thanks so much, Pras Subramanian, there for us. Well, earnings season continues with a pessimistic investor outlook born in mixed earnings. But not all sectors are equal, with bright spots to be found past the mega-cap FANG stocks. Here with some advice to where investors could look, Brian Vendig, MJP Wealth Advisors President. Thank you for joining me, Brian. So we know that sort of going into earnings season, there was a lot of pessimism about how tough the earnings recession could be. What's your take so far, even though it is still early days in earnings season this quarter?
Good morning, Rochelle. Yeah, I think right now the results still are pretty mixed. I mean, we did have a sigh of relief from some of the earnings reports that came in last week and earlier this week from some of the bigger banks. But at the same point in time, investors are still getting back to the fundamentals and focusing on what companies are saying regarding their margins and their profit outlooks moving forward. And I think we are expecting an earnings decline year over year and probably another earnings decline coming up over the next couple of months, because from a macro perspective, we are seeing more and more signs that the economy is slowing and the consumer cannot continue to prop up the economy as much as we've seen over the last couple of quarters. Now, the other thing that's also weighing on investors' sentiment right now, Rochelle, going into earnings, was we got comments from the Fed that they're looking to, again, increase interest rates as expected, but possibly not cutting rates this year. And I think right now, investors are still expecting rate cuts over the second half of the year, which might be too optimistic. And I think investors are positioning around that. Plus, at the same point in time, things are heating up a little bit on the debt ceiling debate in Washington, and probabilities are increasing, unfortunately, on the side that there might be some issues in politicians reaching an agreement where necessary on the debt ceiling debate. So these are all things that I think are swirling right now, and investors are looking for more information from publicly traded companies over the next week or two to really get comfortable on outlooks and quality of earnings.
And as you mentioned there, I mean, we're going to be getting a Fed decision bang smack in the middle of earnings season there on May 3rd. So with that announcement then, how does that then shape the narrative for the rest of the earnings season and then going into Q2?
Yeah, definitely. I think we're going to expect more of the same with companies talking about balancing cost relative to demand and trying to position price increases where they can, while at the same point in time looking for efficiencies in running their business. Now, as it relates to the Fed and policy decisions that they're making there, I think that really impacts more valuations of making investments moving forward, and investors taking a look at the trade-offs between higher interest rates that they can get on cash and other safe investments, and also taking a look at the fixed income market as compared to stocks. So I think we're in a period of time where the market's probably going to stay in a relative range with some of these fundamental as well as macro factors still needing more time to play out. However, when we look towards the latter part of this year into next year, we do expect the earnings numbers to improve, and we do expect more favorable compares for equities, which really truly are a longer term asset investment.
And you mentioned fixed income. It has been a rather interesting time here for bonds, where we're not really in the set it and forget it mode when it comes to bonds at the moment. So because of the volatility. So a lot of people wondering, have they missed the boat when it comes to bond investing? Is there still value to be found here as we await a Fed pause and a potential pivot at some point?
That's a great question, Rochelle, and I really appreciate that, because right now we think fixed income or bonds are fairly valued. Bonds came off of a tremendously tough year last year, one that we have not seen in many decades, with the average bond market being down around 13%. And I think right now, when you think about inflation, we still believe a good probability of coming down over the balance of this year into next year, and the Fed has said the same, that as interest rates come down, we think overall yield curve over time will eventually flatten, especially because on the short-term side, the Fed might ease back in raising rates this year. And I think it's fair to assume they're not going to do it as aggressively as they did last year. And as a result, as interest rates come down, the prices of bonds go up. So as I said before, looking at different parts of the bond market, both on the short-term side and intermediate side, we find attractive. And I think it's something for investors to consider, because over the last couple of years, people have shied away from bonds. But I think right now there's an opportunity for rates to come down moving forward as the economy slows, and also as inflation comes down as well relative to aggregate demand slowing in the economy.
And then also in terms of portfolio allocation, looking at growth versus value stocks, what are some of the sector standouts for you?
Well, right now on a macro level, we're trying to just keep growth and value stocks at parity or evenly balanced, just because of all those things that I mentioned before that are still variables that need some time to play out. But sectors that we like in this environment are the healthcare sector, because right now we think they can play offense as well as defense when volatility picks up. A lot of attractive companies looking at innovation. We've seen a pullback in healthcare. It's something to consider as an opportunity, plus pay as a stable dividend. We like the industrial space as well. With globalization, fractured supply chains coming home, people looking for more efficient ways to support e-commerce, as well as you think about the infrastructure spending that's happening. We think industrials still have some room to run over the balance of this year into next year. And then finally, when you think about a slowing economy and where companies are still looking to make investment, we think cybersecurity is a place within the technology sector that you can find some relatively attractive returns over the long run, because cyber threats, I think, is now just table stakes as part of running a business, and that type of investment needs to be maintained, while maybe you might be evaluating other spends in technology that might not be as critical as an ongoing basis.
Certainly makes sense, especially with the growing push we're seeing with AI as well. Cybersecurity looking more attractive here. Brian Vendig, MJP Wealth President, thank you for your time this morning. All right, stay with us. Coming up, investors are not lighting up the cannabis industry. Headwinds from regulation to piles of debt really impacting the space. How can it move forward, though, and what should investors look for? We'll discuss next.
In Canada, over the last couple of years, we've paid $250 million in taxes that got put back into the economy there. We've created, over 750 jobs, built out facilities for $1 billion. And we have taken, bad cannabis off the street that's laced with fentanyl and stuff like that. So it is frustrating, but Tilray's not going to sit by and depend upon the government. We as a consumer packaged goods business are going to grow our business in cannabis, beer, spirits, and wellness foods.
Well, that was Tilray CEO Irwin Simon earlier this year expressing his frustration over the progress of the cannabis legislation in the US. Flash forward to today, discussions are still in view as US leaders gather to speak on cannabis legislation being discussed and debated by lawmakers. Now, the pace of progress in cannabis legislation remains a point as the market struggles to find legal footing. For more on this, we have Politico federal cannabis policy reporter Natalie Fertig. Natalie, thank you so much. So you're right in the mix of all this happening in DC. We have the lawmakers looking at this. You have, of course, the one side, the decriminalization aspect, the safe banking aspect. Talk about the progress that you're seeing and the discussions that are surrounding both of these today.
Yeah, so this has been a couple years in the making. Congress right now is considering a couple different pieces of legislation. The one that is most likely to move forward in this Congress is the Safe Banking Act, which you mentioned. It's a bill that would make it a little bit easier for cannabis businesses to access banking services, as well as auxiliary businesses like Scott's Miracle Grow or the plumber who shows up to fix the plumbing at the cannabis farm. All of those businesses right now have a hard time accessing banking services, both checking accounts, savings accounts, and also small business loans, which is something that smaller operators in the cannabis industry really want to have access to.
And something that you note, even with safe banking, you note that it's not a catch-all for, some of these other financial issues that are tied to trying to do business here. So what else still needs to be addressed?
There's a lot that still needs to be addressed. There was a bill introduced last week or maybe earlier this week that would address the 280E tax loophole. That bill was introduced in the last Congress and did not move forward. So I'm not sure if it's going to have a lot of momentum in this Congress, but that's a big issue that the cannabis industry is constantly talking to lawmakers about. It's a loophole that means that they cannot write off the majority of their business expenses, things like payroll, on their taxes every year because they are selling a federally illicit substance. It was a loophole that was passed in the 80s, and it's still impacting the cannabis industry really deeply today. It's actually one of the reasons from reporting that Politico has done on why the industry is still having so many struggles in making money. One of my colleagues looked through a bunch of different records last year and found that the largest publicly traded cannabis companies in the United States collectively lost more than $550 million in the first 6 months of 2022, even while making revenues of nearly $4.5 billion. And the 280E tax issue is one of the biggest reasons why they're still losing money.
And of course, the struggling legislation aspect to cannabis clearly showing up in equity markets as well. I want to bring in our next guest with us. Natalie, make sure you stay with us here. Scott Greiper, Viridian Capital Advisors President, also joining us. So Scott, what is this doing then in terms of what we're seeing with equity markets here when you do have this federal legislation sort of stranglehold you're in, maturing markets, and then of course debt also adding to the mix?
Yeah, well, good morning. Equity is dead in the cannabis industry. It's challenged in all sectors, but specifically in the cannabis industry. It's just become too prohibitively expensive, too dilutive for public companies in particular to issue equity, cannabis companies. And so what do? You need to scale your business. You need to grow in other operations so you can lower your cost of production. Thank God for the lenders, the debt financiers coming into this market in the last, let's call it 2 to 3 years. There's been over $10 billion of debt capital coming into the industry, which is an interesting representation. What do lenders always look for? In any business, they look for hard assets, real estate, so that they have good collateral for their loan, and they look for cash flow to be able to service the loan and keep the loan current. And for the larger cannabis companies, particularly the public ones, they've been attracting that debt capital. So equity really is almost non-existent in this market. Debt financing has plugged that gap somewhat.
And Natalie, when we look at some of the issues that are obviously plaguing some of what we call big weed, these multi-stage cannabis businesses, what would you say is the biggest barrier for them right now?
I mean, the biggest issue is just that cannabis is not federally legal. So the banking, 280E, the fact that states like Michigan, California, Oregon that have too much cannabis for everyone within their state market to consume it. They can't send it into states like New Jersey and New York that are still getting off the ground and could use a little extra cannabis or products to be sold in their dispensaries. All of these issues are directly related to the continued state of cannabis federally, which is that it's a controlled substance. It's the same category as heroin on the Controlled Substances Act. So that's what it really comes down to here. And I don't anticipate that changing in this Congress. Never say never, but with a Republican-led House and with President Biden not being wild about reforming cannabis laws in the United States, it is not a likely bill that will pass in this Congress.
And so, Scott, let's talk opportunities here. I mean, Veridian has this cannabis deal tracker looking at the state of M&A in this space. So within the sectors that you follow, are there any areas that are gaining ground? What do you see, what is on the horizon for you? What do you expect to see in terms of M&A activity here?
Yeah, we could just go to our numbers, as you cited, through the Veridian Cannabis Deal Tracker. So of the 12 sectors within the business of cannabis that we tracked since January of 15, everything from cultivation to ag tech to biotech to real estate to brands. Real estate is where the action is right now because it's for the cannabis companies that are large enough to own their own real estate of size. And in the cases where it's unencumbered, it's the easiest asset to convert to cash. You could sell the real estate, you can lease against the real estate, you can leverage it, or you could do a sale leaseback. So real estate is really where a lot of the action is. It's also what attracts the lenders. We've seen an aggregation in several different sectors, which is really healthy. Software. Cannabis companies are getting large enough right now where you can't use QuickBooks or a ledger. You've got to have more advanced ERP solutions, inventory management solutions, accounting systems. So there's been a rapid adoption of advanced software, and that industry has been rolling up. Similarly, on the brand side, this is a consumer packaged good industry at its core. And the brand side is rapidly aggregating because consumers, just like when they go into a liquor store, they don't ask where the potatoes are grown, and they don't ask if it's grown indoor, outdoor, in a greenhouse. They're attached to the brand. They're attached to the way the brand makes them feel. That's ultimately what cannabis is evolving into. So we've seen a rapid M&A consolidation within brands because ultimately the stores, the legal dispensaries, that carry more than 30-40% of their own brands in the store, they're achieving EBITDA margins of between 20 and 25%. They're extremely profitable. So brands matter, and ultimately this is a CPG industry.
So, Scott, for people who are looking at this industry and wondering, is it worth investing? Where are the most profitable places people can invest? And really, who are the cannabis leaders at this point when we look at the performance of some of these cannabis stocks this year?
We're in just a massive dichotomy in the industry. Last year in 2022, there were about $30 billion of legal cannabis sales. So product grown by a licensed cultivator, sold by a licensed retailer, $30 billion. When we started Veridian in June of 2014, all of 14, there was 2.3 billion of legal sales. So in 9 years, we've gone from 2 billion to 30 billion. A 15x increase. Not many other sectors in the world that are showing that level of compound annual growth. And the opposite side of that is valuations are down, public market caps are down, capital availability is down. So in answer to your question, what we're seeing is non-cannabis investors, private equity, large family offices, venture capital, traditional funds, starting to take positions in this industry because they see an industry that has sustainable macro growth, 15x over the last 9 years, growing globally, and yet all news is bad news. Valuations are down. Companies are missing their earnings estimates. And for these non-cannabis players stepping in right now, the pricing risk of getting into the right company in the right state has been significantly reduced. So this is where these buy-side players have made their money, coming into industries that are showing sustainable, predictable growth, increasingly on a global basis, but they're able to buy in at declining asset values. So the price point, the entry point to get into the industry has never been better. So we're just in an interesting dichotomy right now in the industry.
Well, certainly some silver lining there as we await more federal action on this. A big thank you to you both. Viridian Capital Advisors President Scott Greiper, along with Politico Federal Cannabis Policy Reporter Natalie Fertig. Thank you both for your time this morning. All right, coming up, from TikTok to makeup, Comstick stocks have also seen a lot of love so far this year, and TikTok influencers might get all the credit. We'll explain next. Well, it was a fabulous first quarter for L'Oreal, the makeup giant beating expectations with strong sales across its consumer products and dermatology divisions. Joining us now for a look at what's behind this makeup boom is Susan Anderson, Canaccord Genuity Managing Director. Good to have you on the show. So I want to talk about this boom that we've seen. Of course. So we knew we were going to see something of a comeback as people return to office, return to sort of more social activities. But are you surprised at the sort of growth that we're seeing with makeup right now?
Yes, it's really a category that's remained very strong while we've seen some other categories kind of fade, such as home and to some extent apparel post-COVID. But makeups, our beauty in general, continue to be very strong. I think part of it's because we're seeing, the makeup come back as consumers continue to get out. But skincare also has remained relatively strong. So it's really just a category that consumers are engaged with. It's not typically a category that they cut back on a lot during, weaker macro times. And so, we expect this strength to continue as we look throughout the year.
So in terms of demographics, who's doing the bulk of this spending?
It's really across the board. So we're seeing mass cosmetics up very strong. L'Oreal's consumer division, they just reported, was almost up 15%, which is basically their mass cosmetics. We're also seeing players such as e.l.f. Very, very strong, up double digits, in some cases 40, 50%. And then we're also seeing prestige remain strong, which I think has been kind of an area of surprise by some investors because we thought maybe we would see some trading down as inflation pinches consumers' wallets, but we really haven't seen much of that. Maybe a little bit around the edges, but not a lot at all, as prestige has remained very strong.
And while L'Oreal does have, more affordable brands within its holdings there, you see IXIC right there. But you talked about e.l.f. e.l.f. is a very interesting story here. We see that it's actually up 72.7% this year, blowing a lot of these larger competitors out of the way here. Is this just about price, or what else is e.l.f. getting right?
Well, I think e.l.f. is really, one of the modern day mass beauty brands. So, they started off as a digital beauty brand, then expanded into mass food, drug, but they still don't have the space that some of these legacy brands, such as a Maybelline, have. So what they're doing right is they offer very affordable product, in some cases lower price than these legacy brands, and very high quality. They also are very focused on clean sustainability. They're ahead of the game there versus a lot of these legacy brands. And that's what consumers are looking for in a product these days. And then finally, I think they've done a really good job marketing the brand with social media. The younger generation, particularly Gen Z, they discover all of their makeup products online. So I think they've really catered to that generation, and now they're moving into more traditional media, such as the Super Bowl ad they did this year. And I think that's bringing in even more consumers to the brand.
It certainly adds to that list of TikTok made me buy it, because I know that when you see these beauty trends and how easy a lot of the influencers make it. So with beauty being so huge on apps like TikTok and Instagram, how much can we attribute the social media aspect of it to driving sales versus some of the other factors?
Yeah, I think social media has been a big game changer for beauty in general. I think it's really gotten the consumer engaged in the category. It's allowed smaller indie brands to really come up, whereas 30 years ago it was really hard for these smaller brands to you had to get into a store such as a Target or a Macy's or something like that. So it's really allowed continued newness and invention in the category, and I think that's really played a role in driving new products, new categories, and really driving consumers to constantly try new brands and new things.
And, for people who like a brick and mortar store, you also cover Ulta as well. You have initiated Ulta at a buy, and you have a price target of $622. What do you like in Ulta when you compare it to some of the other retailers in this space?
Yeah, so Ulta is really, I view them as one of the best, beauty retailers out there. They rival Sephora, but I think what Ulta has going for them is they play across all categories. So they play across mass, prestige. Now they're getting into luxury. They also have services within their stores that Ulta does not have. So they have hair salons within the store, which I think is going to lead to and already has cross-selling opportunities, particularly as prestige hair care really starts to grow rapidly, double digits. I think that's going to be a big opportunity for them. Also, their locations are off mall, so you don't have to truck through a mall to get to them, and they're very convenient. I think, particularly because of COVID, they've really stepped up the game with their omni-channel capabilities. Shopping online through Ulta or wherever you want to shop is very easy and convenient. They have a number of AR, AI tools that consumers can use online to help them pick out products. And then also finally their loyalty program. So they have a huge loyalty program, really the second behind Target, has 40 million consumers in it. I think there's still room for it to grow. And that really allows consumers to receive points and special promotions, both through Ulta, but then also Ulta at Target. So it's a really great value for the consumer, which I think attracts them to the store.
And that multi-channel approach, and then also having that sort of one-stop shop in the freestanding Ulta stores, a very unique opportunity there. A big thank you there to Susan Anderson, Canaccord Genuity Managing Director. Thank you for your time this morning. All right, coming up, how billionaire Mark Cuban is bringing affordable medications to small towns left behind by the big pharmacies. More on that next. Jeff Bezos isn't the only billionaire breaking into the pharmacy business. Mark Cuban is challenging pharmacy benefits managers with his Dallas-based company, Cost Plus Drugs. His company is now looking to increase access by partnering with independent pharmacies to expand its membership offerings and compete with the big pharmacy chains as they shut down in rural and low-volume areas. Here to discuss is Cost Plus Drugs CEO Alex Oshmiansky, joined by Yahoo Finance's Anjali Kemlani. A big thank you to you both. So obviously you're not new to this. The company is not new to this, but is continuing to expand here. So how do you plan on differentiating yourself, especially as you get some of these other tech companies now also coming into the health space?
Yeah, Mark is very fond of saying our product isn't pharmaceuticals, our product is trust. I think we differentiate ourselves by taking transparency to its logical end, trying to build that foundation of trust with our patients and the providers that partner with us as well, that we're trying to do the right thing. We're trying to cut out the bad acting middlemen in the supply chain and get patients access to their medication and make business more sustainable for the pharmacists and other clinicians that partner in our ecosystem.
Alex, great to see you, Anjali, here. Talk to me about this push into the rural areas and independent pharmacies in particular, because they have been struggling for some time and often get ignored, compared to those retail chains we saw that especially during the pandemic with vaccine distribution. So how does this help and what is the goal here?
Yeah, so my background, I'm a clinician myself. I'm a physician, diagnostic radiologist. I know on a very personal level how important it is to have a clinician in your area that knows you and can provide the care you need. And it's always been in our plan to try to support the local pharmacists who are really in their community, who know their patients, who are really doing the good work there, but are being taken advantage of by bad actors that control the payments. I think it's somewhat crazy just from an anti-competitive perspective that CVS Caremark oftentimes gets to set the rates that independent pharmacists are paid. Like, that's kind of crazy if you think about it. And it's in their interest to try to drive these small pharmacies completely out of business. So our perspective is by cutting out the bad acting middlemen, we can decrease the price to patients while making independent pharmacy, which is so important in these small communities, more sustainable as a business in the long term.
Absolutely, because you help with the volume there. Talk to me about the competition, though, with other PBMs, because just today, Cigna announced through Express Scripts that they, too, are focusing on independent pharmacies and are looking to increase the reimbursement to these pharmacies. How does that compare, or does it compete in any way with what you're doing?
Yeah, funny timing there. No, I think that these companies have, taken advantage of small independent pharmacies for so long. It's hard to envision anything transformative in that regard where they will actually start supporting these communities. I think just look at the history. Has it gone well in the past? It's hard to envision it turning around at this point. From our perspective, our goal is to try to improve patient access, patient healthcare, the ability of clinicians to do their work. So if part of what we're doing is just to, drive change in the industry as a whole, that's a win. If it incentivizes others to act in positive ways, we've done our job.
And we know that the Biden administration has been looking at the cost of prescription drugs and really trying to crack down on some of these excess costs, and that you recently launched the Team Cuban card in Austin. Talk about the competitive edge that really gets passed on to customers versus some of the existing big players in this space.
Yeah, absolutely. And it's all about transparency. I see on the screen here imatinib. That's sort of our extreme edge case example of sort of bad price dynamics in the marketplace. So you see the retail price there is $2,500. For that dose of imatinib, what we see as the actual adjudicated price. So the price, if you have a high deductible plan, that you'll be asked to pay at the counter before you can get that medication is $800. In the meanwhile, our price is $12. And we are, if anything, paying more for that drug from the manufacturer than large chains that are able to negotiate prices with volume as compared to us. So where is that delta of essentially $800 going? It's not going to the pharmacy. It's not going to the manufacturer. So it's just going to all these intermediaries in the supply chain. And sort of the startling thing is, we launched imatinib at this price over a year ago, and the adjudicated price at the counter hasn't changed. I think these big entities are just addicted to these absurd profit margins from these ultra high cost generic products and are unwilling to bring them down. I think our competitive edge is we're small, we're nimble, we're able to, to move forward with these products at the price that they should cost. And we're not addicted to those margins that have been there for, sometimes decades.
Does that play a role, Alex, in what Mark Cuban tweeted about when he announced this, that the big pharmacy chains don't like you? So is that part of it where they are also taking a part of this, especially as we know many of them belong to larger entities now, or are very diversified in what their business lines are? Does that play a role in all this and sort of where the money is going? And how do you differentiate that way?
Yeah, absolutely. All of these entities, the big pharmacy chains are vertically integrated up and down the supply chain. CVS Caremark it's in its name. It's vertically integrated as, a whole, as a pharmacy chain, as a PBM. It has its relationship with through Red Oak, its sourcing program with Cardinal, and it has underneath. I hope I don't get the name of this right. Zinc, its rebate aggregator, which is a subsidiary corporation based in Switzerland that takes a cut of pharmaceutical price dollars, so-called rebate dollars, where it can never be audited before those dollars are sent back to the parent corporation in the U.S. It's just this mess of entities and subsidiaries, who knows how many. We heard of one starting in the Caribbean recently, specifically around generic drugs. I'm not sure if that moved forward, but there are all these complicated price dynamics manipulations that the big actors in this space go through to get additional margin on pharmaceutical products at the cost of largely two groups, individual patients, so the most vulnerable and indigent patients or indigent people in society are being taken advantage of by these sophisticated price manipulations, as well as large employers. Going back to that imatinib example, for the most part, that $800 is being billed back to employers as basically hidden tax on our entire economy. It's basically rent-seeking behavior, and that those resources could be better used elsewhere. So our Team Cuban card, it's a benefits card, not just a discount card. So by default, patients get our transparent cash price, the same one that they would get through our website at their local pharmacy. But we can also bill that back to their employer as well, which multiple independent studies at this point, academic groups from Harvard, Vanderbilt, multiple independent consultancies have all sort of found the same numbers, that our pricing model saves 50 to 60% on drug spend as compared to traditional PBM pricing models. So we're hopeful that we'll not just improve the lives of individual patients, but save the economy significant amounts of money as a whole.
I mean, that transparency is key, especially when you think of how much medical debt people end up getting into just trying to get some of the basic care that they need. We do appreciate you joining us this morning. Alex Oshmiansky, Cost Plus Drugs CEO, and Yahoo Finance's own Angelique Kamlani. A big thank you to you both. All right, coming up, Ford's F-150 is riding into Europe. We'll speak to an executive from the company about its move into Norway and the competition in the space next. Ford's electric future in focus. As competitors turn out new models and its rival Tesla is seeing price cuts squeezing margins, Ford is rolling out its F-150 Lightning abroad to help boost sales of its electric pickup. Here with more, Darren Palmer, VP of Electric Vehicle Programs at Ford Model E, and Yahoo Finance's Praj Subramanian. A big welcome to you both. So first, want to start with you and really just ask, a lot of people wondering why Norway for this launch? I mean, we know that they have a lot of EV growth there, especially per capita, but why choose Norway as your launching point here?
Well, this is really a story about the customers. Since we launched the vehicle, they formed a Facebook group. It ended up with over 4,000 customers on there, and they demanded that we bring the vehicle to the region. And we asked them some questions about how it would fit there. They had all the answers. So we tried out some vehicles there. They worked beautifully. So we committed to launch there first.
Hey, Darren, Prost here. So Norway, probably a good sort of smaller country to launch this vehicle internationally. But where else is Lightning where do you see it going internationally?
Well, Norway is one of the leading EV development countries in the world. They're very far advanced already. Most of the vehicles sold are electric now. So they're one of the first. They also have the terrain outside the cities is perfect for a vehicle of this size. And that's why we tested it there to make sure it would fit. It wouldn't fit in every place in Europe. And so that's why we're starting there first. That's the plans that we're showing today.
So Darren, as the company ramps up EV sort of ambitions there, you got a run rate here of 600,000 EVs by the end of 2026. I'm sorry, 2023, and 2 million by 2026. How is that looking right now? And also, the company is also going to start reporting its operations split differently with EV and also gas-powered companies or gas-powered units separately. How does that affect you as well?
Absolutely. So Ford is all in on electrification. That's why you saw that we arranged the company with Ford Blue, a Model E and Ford Pro, and we're committing over $50 billion to bring a set of vehicles up to 2 million vehicles by the end of 2026. You've seen the investments we put into Tennessee, the huge plant in Tennessee that's going to build a next generation electric truck. And we have a whole slew of vehicles coming that fit into different segments. So far so good. It's going very well.
I like the aspect of the EV side of it. You have this legacy brand, but acting like a startup in the EV space. How nimble does that make you when it comes to reaching these production targets?
Yeah, that's really important because we're a company that we're learning every day on electric vehicles. That division, we look at social media from customers every day, meeting where customers are. They tend to be very passionate about EVs. So we want to learn from them and update the vehicle. So every EV we issue is full over-the-air capable, so we can update them regularly. And in fact, we just did a complete interface update for all of the electric vehicles recently. We added video streaming and gaming and some other utilities to them, and we're constantly doing quality improvements. So it's important that we have a division that can really think that way and be very nimble. That's why we created Model E.
Hey Darren, so staying nimble, kind of a big deal here as the space evolves. You're seeing competitors like Tesla cutting prices again and again here in the States, and also Ford matching that with the Mach-E earlier this year. How is that pressuring the business? Do you guys see the need to continue to respond to that? Is that going to be a problem going forward?
Well, this is a really growth part of the market. We are seeing massive demand for our products. So after we launched them and started production, we saw that we needed many more. And so we had to invest a lot of money to increase the production. And you mentioned earlier, the Lightning, for example, is going up to 150,000 this year. The Mach-E is going up towards 200,000 this year, and the E-Transit is also going up many times from the original plan. So at the moment, we are completely sold out of all of the vehicles. We're, of course, monitoring the situation for dynamics for pricing, and we will adjust as the market sees fit and how our customers value our products.
And some of the issues that Tesla brought up in their call, higher raw material costs, the commodities, logistics and warranty costs, lower revenue for some of these environmental credits falling off as well. How is Ford positioning itself here?
Absolutely. They are all factors. And we did have to increase the price of the Lightning because of that battery material cost increases. So we are in Tennessee, where we're building that huge factory. We're also building recycling, and we're also vertically integrating and securing contracts on all of the materials that we're going to need, so especially the ones that are likely to become scarce soon, like battery materials. We're also bringing in new types of battery chemistries like LFP, lithium phosphate, which uses less of some precious or scarce chemicals, which allows us to offer a lower price and also to be resilient to supply issues. So these are some of the things we're already preparing for.
Hey, Darren, real quick, in the European market, at least, the EV division gonna actually launch the Explorer there, right? The famous nameplate here in the States gonna go to Europe as the Explorer EV SUV. Any chance we'll see that here, or is it just strictly a European model?
At the moment, that's strictly a European model. It's a smaller vehicle, beautifully, perfectly suited to their market. And that Explorer brand and what it stands for, and freedom and going out and having an adventure, seems to be resonating really well. And that's what Explorer stands for here. So far, so good. We're very excited about that. At the moment, that is a European vehicle. So it's a smaller vehicle.
Looking forward to that, though. I'm a SUV person myself, still trying to dip my toe in the EV space here. A big thank you for joining us this morning. Darren Palmer, VP of Electrical Vehicle Programs at Ford Model E, alongside Yahoo Finance's Pras Subramanian. Thank you both. All right, shifting gears to rising tensions between the US and China, increasing geopolitical concerns around a US war with China over Taiwan. Treasury Secretary Janet Yellen spoke about the topic this morning in Washington, laying out U.S. economic priorities with China. Let's bring in Yahoo Finance's Jennifer Schonberger to discuss. So, Jennifer, what did we learn?
Good morning, Rochelle. In a wide-ranging speech on China, U.S. Treasury Secretary Janet Yellen pulled no punches, saying the U.S. is at a tense moment with the world's second-largest economy.
Our relationship is clearly at a tense moment. We seek a constructive and fair economic relationship with China. Both countries need to be able to frankly discuss difficult issues, and we should work together when possible.
Speaking in Washington, Secretary Yellen laid out 3 objectives to the U.S. economic approach to China. First, she says protect U.S. national security and human rights interests. On these 2 tenets, Yellen says the U.S. will not compromise. She says they've made clear that safeguarding certain technologies from China's military is a vital national interest. Second, she says seeking a healthy economic relationship with China. She called on China to play by the rules, saying both countries can benefit from healthy competition, but only if that competition is fair. She noted China's requirement for U.S. firms to provide access to technological secrets to enter the Chinese market. She also said the U.S. is friendshoring to mitigate supply disruptions experienced during the pandemic and investing in manufacturing at home so as not to over-rely on China. Third, she says the 2 countries need to cooperate on global challenges like climate and debt distress, saying that more needs to be done. Now, Yellen says there is no reason to fear competition with China. Over the long run, she thinks China's economy is actually on the decline based on its aging population and thus declining workforce. She also noted the second largest economy's turn towards economic nationalism. On the foreign policy front, Yellen called out China on Russia, saying, quote, China's no-limits partnership and support for Russia is a worrisome indication that it is not serious about ending the war. It is essential that China and other countries do not provide Russia with material support or assistance with sanctions evasion. Yellen says she plans to travel to China at the appropriate time. Rochelle?
All right, thank you for that update there, our Jennifer Schonberger. All right, let's do a final check of the markets before we go. We see all 3 still in negative territory, but well off the session lows. The Dow, though, still there, off about 82 points, weighed down by Verizon and American Express. The S&P 500 there, also down about 0.5% there, being weighed down sector-wise by energy and real estate. Taking a look at the tech-heavy Nasdaq there, that's also down about 43 points, weighed by Tesla. That does it for now. I'm Rochelle Akufa. I'll see you tomorrow at 11 a.m. Eastern.